Hi friends, good evening. Welcome to this marathon for CA Final FR for this May 24 examination. We started this marathon yesterday. Still, we'll be having around 4 more classes. Yeah, initially I thought total 4 will be required, but now I feel total 5 will be required. Okay, so yesterday, which all topics we finished? Yesterday we finished with Introduction to Ind AS, then we did Schedule 3, then we did Ind AS 1, then we did Ind AS 102, share-based payment, and then we started with business combination. Now, business combination is not yet completed. So today, we are going to complete business combination first. Okay, so this business combination is going on. I'll finish that. After business combination is over, we'll go to Consolidated Financial Statement. So after this, your chapter number 13, Consolidated Financial Statement. With that, your Ind AS 110, Ind AS 111, that all will get completed. Okay, sir, after that, I'm going to do your chapter number basically 3 that relates to Ind AS on presentation, so Ind AS 7 on cash flow, and Ind AS 34 interim financial reporting, Ind AS 7, Ind AS 34. And if time permits, I'll do Ind AS 8, 10 and 113. So this is basically today's target, and let's begin with business combination, the remaining portion. Achha, anybody joining new? See, as such, you already know all these things. So in case you were not there yesterday or sitting right now, sir, would I be able to understand? Definitely you will be able to understand. This revision, this is not teaching as of now. So you will be able to understand. You can sit directly, no problem at all. And in case you want to start with a new chapter, the business combination will take around half an hour, 45 minutes. You can finish basically that, and then you can come back and you can start with consolidated financial statements. Okay, so moving ahead. We have business combination achieved without transfer of consideration. Okay, I did not pay anything, but still I got control over the acquiree. Sir, how did that happen? So one option is acquiree comes up with a new shares. Yeah, not new shares, acquiree comes up with a buyback. Okay, the acquiree coming up with buyback, I am not giving, the other shareholders are giving back. So earlier suppose my holding was 40%, I was not having control. But now acquiree comes up with a buyback, other shareholders have given back few of the shares. So now what is happening? Is now number of shares total has gone down, mine are remaining same, the percentage holding of mine goes up. So that is how I got control. How to account for it, I'll come to it. Okay, number 2, minority had a veto power. Now I was holding 60%. Oh, I was holding 60. As such, you have a control, but you had given a veto power to minority people that unless they approve, I cannot take decision. So even though I was holding 60%, I needed approval of minority people. That's why control was not there. The veto power given to minority was for 5 years. 5 years are over. So now I'll be having control. And third one, there's just a contract between acquirer and acquiree. So there's a contract which states that you manage our company and profits will be shared. So I'll be getting control just by contract alone. Now, how to account for this? Under your first and second, you already had certain shares. Now, buyback mein you are not giving, minority ka veto power is lapsing, so you already had certain shares. Control comes now. Okay, control comes now. You get the control now. The previous interest held is to be remeasured. The accounting will be done like step acquisition. So in your A and B, the accounting is similar to step acquisition. Now, coming to C point. It's just by contract alone. How much did I pay? 0. I paid 0. So consideration is actually 0. Consideration 0, but the thing is, you have a control, you need to consolidate, to include assets and liability. NCI will be 100%. And difference will go in your goodwill or capital reserve. So over here, there will be full asset basically attributed to NCI. Assets may fully attributable to NCI. Profits may I share 50%. The profit may attributable to owners of parent 50%. NCI will get 50%. Okay. Now check over here. Question number 39. Sita Limited, Beta Limited, they come together to form a dual listed corporation called DLC. Okay. Now in the board of DLC, there will be 10 members, 6 of Sita, 4 of Beta. So can I say that in the new entity, Sita will be able to control, they have 6 board members. Okay, so accounting will be done as if Sita acquires Beta. Accounting will be done as if Sita acquires Beta. But question is, how much did you pay to Beta? Accounting is done. They are just coming together, forming a new entity. Accounting will be done as if Sita acquires Beta. But question, how much Sita is paid to Beta? Nothing. Nothing I paid. So see, consideration paid is nil. 100% will be allocated to what? NCI. 100% will be allocated to NCI, and question is given NCI is to be measured at fair value. That's why यहाँ पे NCI is at fair value. Net asset was 70. Difference comes in your goodwill or capital reserve. Goodwill is coming 10. Okay, next one. Non-current asset acquired. Non-current asset acquired under business combination held for sale. Okay, some non-current assets are coming under business combination. We don't need it. Immediately they are classified as held for sale. So they will be valued as per Ind AS 105. And as per Ind AS 105, how do I value them? As per Ind AS 105, how do I value them? So they are to be valued how? So they will be valued directly at cost or fair value less cost to sell, whichever, carrying amount or fair value less cost to sell, whichever is lower. Acha, so they are not measured at acquisition date fair value, they'll be measured at carrying amount or fair value less cost to sell, whichever is lower. यहाँ पे will directly take, यहाँ पे will not take carrying amount, यहाँ पे will directly take fair value less cost to sell. I repeat, यहाँ पे will directly take fair value less cost to sell because carrying amount was in other book. हमारी book में है ही नहीं. Okay, so if at all non-current asset coming under business combination which is held for sale, directly measure it not at fair value less cost to sell. Okay, coming to question number 40, important one. Any doubts? Anybody till now? I hope you enjoyed yesterday's session. Give your comments. Okay, now this is November 2020 question. Company A holds 25%, so we already have certain thing. 1st November you acquire further 65, 25 plus 65 now becomes 90. Control now comes, it's a step acquisition. The earlier investment held is to be remeasured. While finding goodwill capital reserve for 65% what I'm paying right now, for earlier 25% take the fair value. ठीक है, total holding becomes 90%. You transfer 59 lakh cash and you're also giving 1 lakh shares and the market price of your share is 10 rupee. Market price is 10 rupee. So can I say 10 lakh rupee? 1 lakh shares into 10. And this will comprise 5% of post-acquisition capital of company A. Okay, this will comprise how much? 5%. So it is not a reverse acquisition. It's not like afterwards they will have a control over us. No. They will have just 5% in our company. Now there's a contingent consideration. Contingent consideration, the fair value of contingent consideration, I need to include it in your PC. So 3 lakh will be included in PC. Achha, and see over here I'm required to pay cash. It will be treated as a liability and wo remeasurement, that remeasurement gain loss will go in your P&L. Now the transaction costs, transaction related cost, acquisition related cost, they go directly in P&L. Okay, so in your PC 59 lakh plus 10 lakh plus ये कितना था 3 lakh. ठीक है. Next, NCI, they elect to measure NCI at fair value 750 already given to you. Previously held interest today is worth, in your book it is 6 lakh, but the fair value is 20 lakh. So while finding goodwill capital reserve include 20 lakh. And 6 becoming 20, 14 lakh gain will go in your P&L, assuming they are carried at cost or FVT P&L in SFS. And identifiable net asset are 60 lakh. We are required to determine the accounting. See the question. Determine the accounting under acquisition method. I'll show you. Determine the accounting under acquisition method. How do we write answer? I told you theories are very important. You can't skip theory. So check over here how the answer is written. Okay, as per Ind AS 103, acquirer is generally the entity which basically acquires assets and liabilities of another entity upon payment of consideration. So over here, A Limited is the acquirer. It's not a case of reverse acquisition. Fine. So we found acquirer. After that, acquisition date is the date from which you get control. So you're getting control from 1st November, the second lot which you acquired. Third, consideration for business combination will be the fair value of assets transferred, liability incurred or equity instruments issued. So we have given cash, we have given some equity shares. Contingent consideration, I need to include it at acquisition date fair value. Acquisition related costs will go in your P&L. NCI can be either at proportionate net asset or basically at fair value. Question said fair value, that's why it will be 750. Okay. At acquisition date, the previously equity interest held is to be remeasured. That 14 lakh ka gain is coming, that will go in your P&L. Fine. And assets and liabilities coming in are to be recognized at acquisition date, fair value. Okay. Now let's find out goodwill or capital reserve, and then we'll do acquisition entry. Okay. So check over here. First, for this 65%, I gave cash 59, equity shares 1 lakh into basically 10 rupee. This is done. Fair value of contingent consideration is 3 lakhs. Fair value of contingent consideration 3 lakh. So this is for 65%. For another 25 which we already had, take the fair value 20 lakh. So you got basically consideration is 92 lakh. Add NCI, fair value pay. NCI is at fair value 750 minus the fair value of identifiable net asset 60 lakh. This is coming as your goodwill. And now acquisition entry. Now comes your acquisition entry. We'll have a single entry, combined one. Acquisition entry. Okay, so acquisition entry, identifiable net asset comes in 60. Okay. NCI coming in will have a credit balance. NCI is 750. Okay. How much did you pay? How much did you pay? I paid 59 lakh plus I gave shares worth rupees 10 lakh. Okay, there's a contingent consideration payable 3 lakh. It will appear as a liability. It will be remeasured every year. That remeasurement gain loss will go in P&L. Earlier investment goes away. Earlier investment is going away. So earlier investments are to be remeasured right now. वो remeasure करके कितना आया 20. So 6 lakh investment, 14 lakh went in P&L. 6 lakh investment, 14 P&L. Or if you had already made a separate entry for that, then in that case you can directly write to investment 20 lakh. So you would have taken 14 lakh separately in P&L. And difference is basically your goodwill. This is basically the acquisition entry. ICI passes only one entry like this. Clear? Okay, moving ahead, this was question number 40. Keep smiling, pay attention. Any doubts are there, stop me at the same time. Okay, question number 41. ABC acquires 75% equity shares of JKL on 1st July. 1st July, you're acquiring how many percentage? 75. Okay, the issued shares of JKL is 1 crore 20 lakh shares. Okay, we acquired 75%. So can I say we acquired 90 lakh shares? 1 crore 20 lakh are there. We acquired 75%, 90 lakh. Okay, how are we giving? We issued 2 shares for every 3 shares. So can I say I'll be giving you into 2 by 3 my 60 lakh shares. My 60 lakh shares are given to you. And my share as a market value 6.5. Okay, my share as a market value what? 6.5. Fine. The equity shares of ABC is 6.5 into 6.5. Okay. Now on 30th June 18. Now check out when did we acquire? 1st July 17. 1st July 17 we acquired. Now they are telling in June 18, after 1 year. After 1 year we will, it's not we may or may not, we will make a payment of 7150. So this is not a contingent consideration, this is mandatory, deferred. So it's just a deferred consideration, not contingent, mandatory payable. You include it in your PC today at its present value. The 7150 ka present value will be taken in your PC. On 19, we may give a cash payment of 3 crore. This is contingent upon revenue. This is contingent consideration. The fair value of contingent consideration on acquisition date, include it in your PC. So July May, the fair value, 1st July 17, it is 250. Take this in your PC. Then 250 later on becomes 220. That will go in your P&L. Okay, carrying amount of net asset coming is 6 crore. Fair value of net asset is 7 crore. We know that. For identifying or finding out goodwill, we need to take the fair value of identifiable assets and liability. Now, whenever the assets and liability ka fair value goes up or down, I have to consider the deferred tax impact. I have to consider deferred tax impact. Sir, why we had not considered till now? Till now, question did not give us the tax rate. But here they've already given you tax rate 20%. Okay, then now pay attention. Asset going up. In SFS, asset is still 6 crore. In SFS, asset is still 6 crore, but in CFS, I'll be recording asset at 7 crore. We acquired basically 75%, it becomes our subsidiary. तो SFS में still it is 6 crore, CFS में it will become 7, asset goes up. So how do I have the deferred tax impact? See, if carrying amount of asset in books, in your books asset went up, it's a profit for you, but you will be paying tax later to create a DTL. Asset goes up, DTL. Asset goes down, DTA. Liability goes up, DTA. Liability goes down, DTL. ठीक है, तो over here 1 crore asset is going up, 1 crore का 20%, 1 crore का 20%, 20 lakh DTL to be created. So now your net asset will not be 7 crore, 7 crore minus DTL of 20 lakh, that will come as 6 crore 80 lakhs net. Okay, now there was poorer performance, and because of that there's an impairment of goodwill 10%. So find goodwill first, then there's an impairment of goodwill 10%, and we are required to find out the impairment of goodwill under both method, assuming NCI is at proportionate net asset or NCI is at fair value, both the method. Okay, coming to the solution. Okay, to check over here, we go to consideration by acquirer first, working note 1. So we are required to find out the consideration which we are paying. So first of all, we are giving them 60 lakh shares. Our share is worth 6.5. Out of their 120, we acquired 75%, 90 lakh we acquired. 90 lakh mein for every 3 shares, I'm giving my 2. So I'm giving 60 lakh share. My share is worth this. So this. Now there's a deferred consideration, uska present value, and fair value on acquisition date of contingent consideration is 2 crore 50 lakh. To total it out, you will be getting 70-50. Total it out, you will be getting 70-50. ठीक है, तो वो 70-50 हो गया. Okay, NCI either is at proportionate net asset or is it at fair value. If it is proportionate net asset, your net asset are not 7 crore. वो DTL के बाद में it becomes 680. And if it is proportionate net asset, 680 is 10%. Sorry, not 10, 25%. We acquire 75%. So 680 का 25% NCI becomes this. अच्छा, if NCI is at fair value, तो they hold 30 lakh shares of that company. वो 30 lakh shares of that company, not mine. Mine is 6.5. उनका share is worth 6 rupee. So 30 lakh into 6 is to be taken. So this is how it is to be done. Difference is goodwill. We found goodwill. Impairment of goodwill is 10%. Clear che? Okay, moving on to the next question. These are all very good questions. Pay attention. Question 42. Okay, asked in November 19 as well as May 22. We have a balance sheet of Professional and Dynamic 2 company, March 22. ठीक है, standalone balance sheets are given. This is basically Professional, this is Dynamic. Property, investment, this all is fine. Reserve, OCI, these are all part of other equity. If we are required to prepare a balance sheet, I'll put it under the heading other equity. ठीक है. Now Professional acquired 70% in Dynamic 1st April. Same day. We acquired 70% and we are giving our share. 1 share of Professional for every 2 share of Dynamic. For every 2 share, I'm giving how many? 1. Okay, check out how many shares are there in Dynamic. So Dynamic ka capital is 400 lakhs. Dynamic का capital 400 lakh. ठीक है, 1 share is of 100 each. अच्छा, तो 4 lakh shares are there. Okay, out of 4 lakh shares, I acquire 70%. So 2,80,000 shares I'm acquiring. And for every 2 shares, I'm giving 1. I'm acquiring 2,80,000. For every 2 share, I'm giving 1. So can I say I have to give 1,40,000 shares of mine? And my 1,40,000 share are worth 40 rupee. So 1,40,000 into 40, PC will become 56 lakhs. PC will become 56 lakhs. Okay, now the fair value of PP is 350. So whenever I am basically having assets and liabilities coming in are at acquisition date fair value, so PP take 350. Okay, now Professional has also agreed to make an additional payment. I have agreed to make additional payment higher of 35 lakh or 25% of some extra profit. 35 lakh or 25% of some extra profit, and this will be due after 2 years. So see, I will be paying higher of this too. I'll be paying higher of this too. So imagine that 25% of extra profit itna nahi ho raha, so I'll pay minimum 35. So minimum 35 I need to pay after 2 years. Ye pakka pay karna hai. It's a deferred consideration. Include it in your PC at its present value. Fine. Next, in addition, we are going to pay to one of the founder shareholder वो employee भी होगा. We are paying him 20 lakh provided he stays. अच्छा, तो this 20 lakh is not a contingent consideration to shareholder. No. Provided he stays. So this is given in capacity as an employee. If this is given in capacity as employee, it doesn't come under Ind AS 103. It will fall under Ind AS 102 or Ind AS 19, accounted as employee cost. Leave it. Okay, now dynamic. The old company already had some ESOPs. Now their ESOPs are replaced with our ESOPs. Okay, तो याद आया ये employee share based payment award exchanged. तो now exchange होगा, तो we need to find out pre-combination period, post-combination period. Pre-combination period will be included in your PC. Post-combination period will be recognized as an employee cost over the remaining vesting period. Now, how do I find out pre-combination period? The fair value of original award today is 5 rupee. Fair value of original award today is 5 into number of years completed. Number of years completed is 2. Divided by total number of years. Divided by total number of years, so under original or new, whichever is higher, so divided by 4. Okay, so 5 into 2 by 4. 5 into 2 by 4, 2.5. Include it in PC. I'm not paying it today. So while making journal entry, it's credited to SBPR. Include 2.5 pre-combination in PC. And what will be post-combination? Post-combination is replacement award is worth 8. Usme pre-combination 2.5. So remaining 5.5 is post-combination. Okay, the total 8 minus 2.5, 5.5 post-combination, that will be recognized as an employee cost over the remaining vesting period. Okay, now there's a lawsuit pending with the customer. The claim is 50. Management can reliably estimate the fair value of liability. Acha. So as such, it was a contingent liability, litigation. But we are able to measure it reliably. We will record it as an actual liability. So we'll record actual liability of rupees 5. Now PPE went up or down something. Liability, it was contingent in their book. We recorded actual. So liability goes up, DTA. Liability goes up. It's a loss, but it will be allowed later, DTA. And if you just check out, वहाँ पे PP कितना था? 350 is the new value. What is the old value? 500 becoming 350. PP going down, that's also DTA. Okay, that's also DTA. So on 150 plus 5 दोनों पे DTA 30% to be created, 46.5, 45 and 1.5 DTA is coming. In your balance sheet, DTL is there. In your balance sheet, this too is DTL. Plus there's a DTA coming. Net will appear in the new balance sheet. Okay, coming to the solution. This was already done. Okay, here only it's written. In material only the solution is written. Okay, coming to first of all the PC part. We are giving our out of your total number of shares, we are acquiring 70%. We are giving you 1,40,000 shares at rupees 40.56. For deferred consideration, 35 lakh mandatory to be paid after 2 years, it's 28.93. And for that replacement award, the pre-combination period 2.5 included in PC, 87.43. 87. There's no contingent consideration. That contingent payment was as an employee, that goes as an employee cost over the remaining period he has to serve. The investment comes up in your SFS. In SFS, investment comes up. You're paying 56 by shares, so equity share capital, securities premium, deferred consideration payable, and this is SBPR. 2.5 pre-combination period will be SBPR. Now, while preparing CFS, what happens while preparing CFS? This investment goes away. Assets and liabilities of theirs are coming in at acquisition date fair value, and the difference basically goes in goodwill or capital reserve. So check out यहाँ पे if it is given a note, let me just see. So this all assets and liabilities are coming in. PP is at new value. Provision for contingent liability. They had shown contingent. We are measuring as actual, that too. And uska deferred tax impact is also coming, 45 and 1.5 DTA. So this is the net. So these are net assets coming in. NCI comes in. Your investment actually goes away. Difference goes in goodwill or capital reserve. NCI Done. Difference यहाँ पे आया goodwill और capital reserve. There's a gain on bargain purchase 274.12. अच्छा, reason for gain on bargain purchase clear. It comes in OCI. From OCI it goes to capital reserve. Reason for gain on bargain purchase not clear, directly in capital reserve. तो check out, ये kind of extract है. What happens? Effect. There's not the CBS, there's the effect in CBS. The net asset comes in, NCI comes in, your investment in delimited goes away, and the difference is basically your goodwill or capital reserve. Now when I'm preparing a balance sheet, all figures of professional remains as it is. They've given some shares, deferred consideration payable is there, contingent, then there is SBPR, that all will be coming. Now in that the figures of dynamic are added, but the fair value, uske assets and liabilities of dynamic will be added, not their capital, not their reserves. The assets and liabilities of dynamic will be added, but at acquisition date, fair value. Is it clear? Is it clear? Okay, moving ahead. Next is Common Control Business Combination, CCBC. Now this concept is not there under your IFRS. IFRS में this is not there. Under Ind AS, yes we have it. Ind AS में है, IFRS में नहीं है. So something which is not there in IFRS we've added, that's called carve in. Fine. Now CCBC is what? It's a business combination involving entities or businesses. It's a business combination involving what? Entities or businesses, where all the combining entity before and after, they are controlled by the same party or parties. They're controlled by the same. So earlier also they were controlled by same party. Now also they are controlled by the same party, and that control is not transitory. तो वो transitory, temporary नहीं है. So it's like basically earlier also you were under same control, now also you're under same control. That is called as common control business combination. So amongst group entity only one entity sold to another entity. So generally amongst group entity, one entity sold to another entity, that will come under kind of CCBC. That will come under CCBC. Or I tell you, Mukesh Ambani is holding more than 50% in 10 companies. Mukesh Ambani is holding more than 50% in 10 companies. Out of that, he gives away one of his holding to that one of the company over there. So now still what happens is ultimately you only will be controlling. So earlier Mukesh Ambani was controlling A Limited and B Limited. Now Mukesh Ambani sold the shares of B to A. So earlier it was Mukesh Ambani to A and B. Now it's Mukesh Ambani to A and A to B. But ultimately still both are controlled by Mukesh Ambani only. That is called CCBC. Whenever it's a CCBC, accounting is done by pooling of interest method. So we need to understand, sir, why it is important. So accounting will be done as per pooling of interest method, and it is possible the entity is controlled earlier and now by a group of individuals who have been acting together under a contractual arrangement. So group of individuals acting together under contractual arrangement, they had control earlier also, now also they have a control, then also it's CCBC, but there has to be a contractual arrangement. So imagine A, B, C, D, there are 4 people, they all hold 25%. They all hold 25% in A Limited also, B Limited also. So now if I ask you who controls A Limited, B Limited, see everybody has just 25%. So as such no one. But if A, B and C has decided to vote together only, if there's a contractual arrangement between A, B and C, so I can say that A Limited as well as B Limited both are controlled by A, B and C only. So A, B, C jointly control them. वो jointly they are controlling. ठीक है. Now moving ahead, important over here will be accounting for CCBC. Whether it's a CCBC or not, that question generally don't come. Okay, how do I account for CCBC? If it's a CCBC, the accounting will be done as per which method? Pooling of interest method. And as per pooling of interest method, what do we do? Okay, so as per pooling of interest method, all assets, liabilities as well as the reserves, everything comes in. So normally under acquisition method, the assets and liabilities of the acquiring entity comes यहाँ पे. So when we are acquiring someone, उसके assets liability come. Here assets, liabilities, reserves, everything come at book value. No, not at acquisition date fair value. Everything comes at book value. We don't change the book values unless it's required to harmonize the accounting policy. ठीक है? The identity of reserves is preserved. So whatever reserves were there, the same comes over here. And now we would have paid something. We would have paid something. Acha, to PC. PC, how do I find out PC? If I'm giving cash, cash given is PC. If I'm giving any asset, acha, I acquired your business, I'm giving asset. If I'm giving asset, the fair value of asset given is PC. But if I'm giving you shares, if I'm giving you shares or debentures, then PC will be based on nominal value of securities issued. If cash is given, PC is nothing but the amount of cash given. If asset is given, I take over your business, I'm giving a land to you. The fair value of land will be PC. And if securities are issued, the PC will be the nominal value of securities issued. ठीक है, and difference between assets, liability, reserve coming in and what I paid, उसका difference goes in capital reserve. There's nothing goodwill over here. There's nothing goodwill over here. The difference between purchase consideration and amount of share capital. Now, why the word amount of share capital written? Assets, liability, reserve. Okay, the asset may say you remove liability, you remove reserve. Difference is nothing but the share capital only. So that's why they say basically the difference between PC and the amount of capital shall be transferred to reserve, capital reserve. And one more thing, if it's a CCBC, accounting is done as if we are together from beginning of previous year. The previous year's figures are to be restated. Okay, so under your acquisition method, normal business combination, the previous year's figures are not restated. But under CCBC, accounting is done as if we are together from beginning of previous year. The previous year's figures are also to be restated. Okay, so last year में भी आप साथ में थे. It will be like that. And now, so we assume we are together since beginning of previous year, provided common control was there at beginning of previous year. Achha, if common control was not there at beginning of previous year, so we assume that we are together since the date common control was there. Since the date common control was there. So there is a restatement of prior period required under CCBC, not under your normal business combination. Okay. There's a question on this which is important. So under CCBC, we are assuming we are together since beginning of previous year, provided common control was there at beginning of previous year. If common control was not there at beginning of previous year, then we assume we are together since the date common control was there. Okay, check this question number 47, already marked as important. Okay, the common control was there beyond the start of comparative period, means before the beginning of previous year, common control was there. So PQR, XYZ, basically both PQR, XYZ have been controlled by the same shareholder since inception. So यहाँ पे accounting will be done as if we are together since beginning of previous year only. And second वाले case में the common control was not there at beginning of previous year. Common control was not there at beginning of previous year. Common control came in 1st October 8. Beginning of previous year is 1st April 8. So 1st April 8 it was not there. So we will account it as if we are together not from 1st April but 1st October 8. Okay, so check over here. As accounting is done as if we are together since beginning of previous year, in the first category common control was there at beginning of previous year also. So I need to give 3 column in balance sheet, current year and previous year beginning. And previous year beginning also it's ABC plus XYZ. P&L में only 2 column. In the second case, the common control was not there on 1/4. So now we assume we are together from 1/10. Now we are together from 1/10. तो यहाँ पे previous year beginning common control was not there, तो we don't need 1/4/18 का balance sheet. 1/10 से it is basically like we are together. That way accounting will be done. ठीक है, this is CCBC. Going ahead. Okay, next point is demerger. Actually, only 2 points are left in this chapter. One is demerger and second one is reverse acquisition. Okay. Coming to demerger, demerger is nothing but one entity, you split it into two or more companies. So one entity having two or more divisions, you're splitting each of the division into a separate company altogether. Okay, so now the thing is, the company from where the division is separated, that's called as a demerged company, and the new company which is formed with that division, that's called as a resultant company. Okay, demerged company will pass entry for assets and liabilities going away. The assets and liabilities of mine are going away. And the resultant company will pass entry for assets and liabilities coming in. Okay, now the resultant company is getting that assets and liability, they'll be paying, and generally it will be paid by the shares only. Now, resultant company may give shares to the demerged company, or resultant company may give shares directly to the shareholders of demerged company. So if resultant company gives shares to the demerged company, resultant company becomes a subsidiary of demerged company. But if resultant company gives shares directly to the shareholders of demerged company, then in that case, demerged company is not getting anything. You are giving shares directly to the shareholders of demerged company. Okay. Fine, moving ahead, how do I account? So first of all, for demerged company, they will pass entry for transfer of assets and liabilities. If I am getting share, investment in equity share of resultant company comes in. So investment in equity share of resultant company comes in if I am getting shares. Okay. So investment in equity shares of resultant company comes in. From my book, assets and liabilities of that division go away. They go away at book value. Assets and liability of that division go away. They go away at book value. And difference is nothing but a profit or loss on demerger, and that will go in capital reserve. Profit or loss on demerger, that goes in capital reserve. If capital loss hai, capital reserve not available, then we take it in P&L loss. Profit definitely goes in capital reserve. This is if we get the shares, investment in equity shares of resultant company comes in our book. But if they give the shares directly to a shareholder, we did not got anything. Babaji ka thullu. But our assets and liabilities went away, liability goes away, book value, asset goes away, book value. Difference is profit or loss on demerger. This is in the books of which company? Demerged. Now resultant company. Now coming to resultant company. Now in your resultant company's book, we need to understand whether it's a CCBC or not. Whether it's a CCBC or not, only for resultant company. Demerged company doesn't matter. If the thing is, earlier also that division was controlled by same shareholder, now also that division will be controlled by same shareholder, so wo kya hoga? CCBC. But the thing is, earlier nobody controlled AB Limited, and nobody will control that separate new entity formed also. So if one of your shareholder was holding more than 50% in demerged company, and then that shareholder will also control the resultant company also. So then in that case, it becomes CCBC. If it's CCBC, the assets, liabilities will be recognized in the books of resultant company at book value. If it's not CCBC, assets, liabilities will be recognized in the book at fair value. Okay, so when it's not CCBC, asset comes in, fair value, liability comes in, fair value. We paid something. Now, whether we give it to the demerged company, or we give it to the shareholders of demerged company, doesn't matter to us. To us, it doesn't matter whether I'm giving to demerged company or whether I'm giving it to the shareholders of demerged company. It doesn't matter, and difference goes in goodwill or capital reserve. If I paid more, it's goodwill. If I paid less, it's basically capital reserve. This is if it's not a CCBC. If it's CCBC, assets, liability, reserves also of that division, they all will be coming at which value? Book value. Whatever I paid, वो purchase consideration, difference goes only in capital reserve if it is CCBC. Okay. Now question number 51, we have this Maxi Mini 2 divisions. So the company's name was Maxi Mini Limited, and they had two division, Maxi and Mini. Fine. Now what is given over here? New company Mini Limited is formed to take over assets and liabilities of Mini Limited, Mini division. I assume nobody was controlling Maxi Mini, so nobody will control Mini also. It's not a CCBC. Okay. So how do I have the journal entry? In both the books they are asking? Is the solution given here or I have written? Okay, we have written. We've written the solution. I'll just open up. Okay, question is silent. It's assumed none of the shareholder have control over maximum, so it will not be CCBC acquisition method. Whether it's an acquisition method or CCBC wala pooling of interest, it's only for resultant company. Okay, coming to first of all demerged company. In demerged company, the assets and liabilities are going away. They are giving shares directly to the shareholders of demerged company. So my liability goes away, my asset goes away, and difference is profit or loss on demerger. ठीक है. And in your demerged company, assets liability always go away at book value. Now coming to the resultant company, assets and liabilities are coming in. Assets liabilities coming in, it's not a CCBC, you record it at fair value. The assets coming in, assets are coming, liabilities are coming. We gave this to the shareholders of demerged company, doesn't matter to whom we are giving. Difference goes in goodwill or capital reserve. Ye ho gaya. Second, they're asking to prepare a balance sheet, which is very simple. Third point, they're asking to find out the net asset value per equity share. So now see here, before demerger, after demerger. Before demerger, we had only maximini. After demerger, we have maximini and mini. After demerger, mein do hai. And if you see over here, net asset value per share, how do I have net asset value per share? Total assets minus liability is net assets divided by number of equity shares. You are getting, earlier it was 140. Before demerger. After demerger, 80 plus 60, that's also 140. It is matching. Why it is matching? Reason, all assets and liabilities have been, the fair value is not given. So all assets and liabilities goes away at book value, recorded in new book at book value. Goes away at book value, recorded in new book at book value. That's why the net asset value is remaining same. If it was recognized at a different value, the net asset value would have been different. There's no impact on basically demerger on shareholders' wealth. All assets and liabilities are transferred at book values. I hope this is clear. Okay. Okay, now going to the next question over here. Okay, this was asked in May 2018 exam. There are two divisions, laptop and mobile. Okay, laptop division, mobile division. Company's name was Enterprise Limited. Okay, now division mobile division is now transferred to a new company for rupees 25 crore to Turnaround Limited. And they are issuing 1 crore equity share of 10 each at a premium of 15. But now remember, if it's a CCBC, how do I find out PC? So if securities are issued, PC will be equal to the nominal value 1 crore into 10. If it is CCBC, the purchase consideration is only 10 crore. If it is not a CCBC, the PC will be 25 crore. Automatically, difference will be adjusted in goodwill capital, so don't worry about the difference. Okay. Now, if you see, they have clearly given one of the member was holding 52% in the company. Okay, that guy was holding 52. In new company also will hold 52. So can I say earlier also both divisions were controlled by him. Now also both companies are controlled by him. It will be CCBC. It will be CCBC. As it's a CCBC, how do I account? CCBC say accounting will get deferred only in the books of, it will get deferred only in the books of resultant company. Okay, for the demerged company, assets and liabilities are going away. You are giving shares to the shareholders. You are giving shares to shareholder. Difference is basically profit or loss on demerger. Okay, and it goes away at book value. Acha, now coming to the other company, Enterprise Limited, as it's a CCBC, Enterprise Limited will recognize what? The assets, liabilities and reserves. Assets, liabilities and reserves at book value, and PC will be 10 crore, not 25 crore. So see, as it is CCBC, assets, liability, reserves are recorded at book value. Assets coming, liabilities coming, your reserve also coming, there's a P&L debit balance. Liabilities coming to equity share capital 1 crore into 10. Don't take securities premium. Don't take securities premium. It is CCBC. That's why likh ke yahan pe it has been crossed. Don't take securities premium. It's CCBC. If it was not CCBC, then in that case, then in that case the surplus debit balance reserve will not be coming, and यहाँ पे to securities premium 15 will be there. Okay, that's the only difference if it was not CCBC. Anybody having doubt with this question? Anybody having doubt with this question? Okay, thank you. Keep on replying. ठीक है. Now, going to the next word, which is called as reverse acquisition. Now, reverse acquisition comes into picture when a smaller company acquires a bigger company by issuing shares. Okay, so there's a smaller company which acquires a bigger company. So I am acquiring your shares by giving my shares. Now, you are a bigger one, so can I say I need to give much more shares of mine? As you are a bigger one, I'll be giving you much more shares of mine. As I'm giving you much more shares of mine, eventually in the combined entity, your shareholder will have more shares in our company. So combined entity mein your shareholder will have more shares. So accounting will be done as if it's not A Limited acquiring B. Accounting will be done as if B acquires A. So check example over here. The reverse acquisition happens when the entity issuing security does not obtain control, but the entity whose equity interest is being acquired, they become the acquirer. ठीक है. Suppose A acquires B. So legally A is acquirer, B is acquiring legally. But based on number of shares issued by A to the shareholders of B, I am a small company, you are a big, I am acquiring you by giving my shares, so I have to give many more shares. I have to give many more shares to you. ठीक है. So based on number of shares issued by A Limited to the shareholders of B Limited, the shareholders of B Limited will have a majority in A Limited. The shareholders of B will have a majority in A, so indirectly B shareholders are controlling A Limited. Indirectly B shareholders are controlling A Limited. This is called as reverse acquisition. Accounting wise, acquirer is B, acquiree is A. So accounting will be done as if B acquires A. So all the figures of B remain as it is. All the figures of B remain as it is to the figures of B. To the figures of B, assets and liabilities of A. Assets of liabilities of A are added at acquisition date fair value. So accounting will not be as if A acquires B. Accounting will be done as if B acquires A. Fine. So under reverse acquisition, how to account? Pay attention. So under reverse acquisition, accounting will be done as if the accounting acquirer, B, acquires basically A. So in our question, it is B acquiring A. To the figures of B, the fair value of assets and liabilities of A are added. Goodwill capital reserve will also be calculated as if B is acquiring A. See the question, it will be more clear. See the question, it will be more clear. Okay, question number 53. A and B operate in power industry, both are basically working in same. A has much larger operation than B. Company B merges with A such that the shareholders of B would receive one equity share of company A for every one share of company B. अच्छा, one की जगह one, such issue of share will be 20% of the issued capital of combined entity. Acha, so I am acquiring, I'll give you my shares will be 20% only. It's not CCBC, it's not basically, it is not reverse acquisition. So why it was marked important? It was not important as such. So it is not a reverse acquisition. Okay, coming to question number 55. Actually, this question is on CCBC. It's not on reverse acquisition. Let's just do it. It's on CCBC. Company A decided to spin off the existing business. Currently, it is basically two companies, B and C. Now, A is formed. Company A incorporates a new entity D. New entity D is formed. Company D signs an agreement to purchase B and C in cash. So, currently A has two companies, B and C. Now company A forms D. आपने D form किया. D issues shares to outsider. D raises fund. In D, other shareholders are there. Now with that money, D acquires A and B. So earlier A and B were under the control of A. Now A and B are under control of D, and D में D में there are other shareholders. A is just very small. So earlier B and C were under A, now B and C are under D, not, and D is not under A. D is not controlled by A. So can I say earlier control different party, now control different party? It is not a CCBC. It is not a CCBC. Fine. Question number 56, important. December 21 exam, this was asked. Okay, AX and BX amalgamated and new company ABX is formed. AX and BX amalgamated, new company ABX is formed. This is the balance sheet of AX and BX. Okay. This is the balance sheet of AX and BX. And they're telling ABX, the new company, AX and BX combined, they form ABX. ABX issued requisite number of shares. How many? Not given. To the shareholders of the transferor company. Okay. Show the purchase consideration and discharge thereof, assuming both are under common control. Oh, both are CCBC. If it's a both are under common control, it becomes a CCBC. CCBC mein assets, liability, reserve, everything comes. Now see, normally, pay attention. Normally, when PC is not given, we assume PC is equal to the fair value of business or based on fair value of net asset. Question gives you fair value of business, the fair value of business is PC. If question doesn't give you fair value of business, तो based on fair value of net assets coming in, assets and liabilities का जो fair value है ना, तो that becomes PC. That is under your acquisition method. Under pooling of interest method, the assets, liability, reserve come in at what value? Assets, liability, reserve come in at what value? Sir, book value. And if nothing is given, we assume PC is equal to your share capital. If you check in this question, the share capital is 6 and 7. ये 6 है, यहाँ पे 7 है. So nothing given, PC will be assumed to be equal to 13,000. ये 6 plus 7. But I cannot say for AX it's 6 and for BX it's 7. No, the company giving me more net asset will get more PC. Company giving me more net asset. Accounting wise, we account assets, liability, reserve, but practically reserve is nothing. I cannot say, oh, take my general reserve. क्या ले जाओगे? तो ओके, अकाउंटिंग वाइज भी रिकॉर्ड कर रहे हैं एसेट्स, लायबिलिटी, रिजर्व. ठीक है. एंड वी अज्यूम पीसी इज इक्वल टू योर पेड अप कैपिटल ओनली, सो दैट देयर इज नो डिफरेंस कमिंग. व्हेनेवर यू टेक पीसी इज इक्वल टू एनएटीओ, देयर वोंट बी एनी गुडविल कमिंग. यहाँ पे भी सेम वे, हियर वी रिकॉर्ड एसेट्स, लायबिलिटी, रिजर्व, तो वी अज्यूम पीसी इज इक्वल टू पेड अप कैपिटल, तो नो डिफरेंस कम्स. So PC is 13,000, but the company giving me more net asset should get more PC. So 13,000 divide between both the companies in proportion to the net assets coming from them. 13,000 divided between both the companies in proportion to what? The net assets coming from them. Let's see over here the solution. Okay, case A, when it's a CCBC, under pooling of interest method, when PC is not given, we assume PC is equal to share capital. Reason is so that there's no adjustment coming in capital reserve. Fine. So over here, the total PC will be 13,000, but our total PC, I cannot say 6 of AX and 7 of BX. No, company which gives me more net asset should get more PC. So now we are finding out the net asset coming from each one of them. This is the net asset coming from each one of them. So PC for AX, PC for BX, we found out. PC for AX, PC for BX, we have found out. ये हो गया. Now we are required to prepare a balance sheet. Total of all assets, book value. Total of all liability, book value. Total of all reserve, book value. And we are giving this 13,000. ये भी total. Indirectly, total of all things will remain same. This is first case. Now second, if you see the question over here, assuming BX is a larger entity, and their management will have a control over the entity. Achha, assuming BX is a larger entity. Now in exam they'd asked, just given the larger entity, the management of larger entity will have a control. Now which is a larger entity? To see the fair value of business. Fair value of business AX 11, BX 14. So I can understand larger entity is BX. So now If larger entity ka management will have a control, accounting will be done as if BX acquires AX. Accounting will be done as if BX acquires AX. Okay, BX is acquiring AX. How much I need to pay to AX? How much we need to pay to AX? Sir, 11,000. Uska fair value. So 11,000 is the PC. 11,000 is the PC. Did you got it? Acha, now in BX, so see, company ka name will be ABX. New company is ABX, but substance wise, BX will control ABX, so that is nothing but BX only. So accounting is as if BX acquires AX. Okay, so we are acquiring AX, we have to pay 11,000. Okay, we are giving our share. Acha, my one share. BX ka one share. Fair value 14,000. Number of shares was 700 tha. 14,000 divided by 700, it becomes 20 rupee. So my one share is worth 20 rupee. My one share is worth 20. I have to give 11,000. So I'll give 550 shares. I'll give 550 shares. My one share is 20 rupees. How did I got 20 rupee? 14,000 divided by 700. So divided by basically 20 rupees, I'll give 550 shares basically to them. Okay, so I'll be giving 550 shares at rupees 20. I'll be giving 550 shares at rupees 20, total 11,000. Acha, assets and liabilities of AX will come up. Only assets and liabilities. It's not CCBC now. First question was CCBC, second is not CCBC. Now, so assets and liabilities of AX will be coming. Acquisition date fair value, fixed asset ka fair value, inventory ka fair value is given. PC is basically 11,000. Difference will go in your goodwill or capital reserve. Did you understood? Okay. So if it is not CCBC, PC is generally assumed to be equal to fair value of business. Okay. Now coming over here to the point number B, if larger entity has a control, so legally ABX is the acquirer, but accounting will be done as if BX acquires AX. So accounting will be done as if BX acquires AX. So accounting acquirer is BX, accounting acquiree is AX. So all figures of BX will be same. All figures of BX. BX ka assets, liability, reserve, capital, everything same, including reserve also. AX ka only assets and liability comes. Of AX only assets and liability come, that too at acquisition date fair value. We are paying them 11,550 shares at rupees 20. Difference goes in goodwill or capital reserve. So check out all figures of BX would remain same, including the reserve. To the figures of BX, what is going to happen? The assets and liabilities of AX will be added at what value? Fair value. Okay, the shareholders of BX will get the similar share of ABX because now new company ka name is not BX. The shareholder of BX gets the same number of shares of ABX. And now to AX ke shareholder, we gave them 550 share. They are given at rupees 20. 10 goes in capital, extra 10 goes in securities premium. Now PC for acquisition of AX, we are acquiring AX, so fair value of business is 11,000, we are giving 11,000. How it is discharged? By giving requisite shares, okay, of ABX, but ABX is nothing but BX only. So in substance, ABX is equal to BX, so shares will be issued at the fair value per share of BX. Fair value per share of BX is 14,000 divided by 700, it comes 20. So 550 shares are to be given. Now, how do we find goodwill or gain on bargain purchase? PC 11, assets and liabilities are coming, not the reserve. And difference 900 is coming in your goodwill. Any doubts? Anybody with this question? Any doubts? Anybody with this question? 56. Okay, going to question number 57. Again, a good one. Okay, entity A issues 2.5 share for each share of B. So for every share of B, I'm giving 2.5 share. Okay, so try to understand how many shares are there in B. Try to understand how many shares are there in B. B mein there are 60 shares. For every share, I give 2.5. So 60 ke badle I have to give into 2.5. I'll give 150 shares. Okay, I'll give 150 shares. Okay. Now just pay attention. In my book, there are 100 shares. I acquire B Limited. I acquire B and I give them 150 shares of mine. So now total 250 share, but out of 250, 150 shares shareholders of B will be having. So now the thing is, actually legally A acquired B. Legally A acquired B, but now the shareholders of B will have more number of shares in A. The total shares in A will be 250. Out of that, 150 are with shareholders of B. So legally it appears A acquired B, but B shareholder will have a control over A. So accounting wise, it is B acquiring A. Accounting wise, it is B acquiring A. Did you got it? ठीक है. The fair value of each share of B is 40 and A का fair value is 16. And the fair value of A's identifiable assets and liability, A के identifiable assets and liability are same except उसके जो non-current asset है, that is 1500. Non-current asset of A is 1500. This is given. Now if I just go to the solution. Okay, it's given here only. Okay, so legally A acquired B, but what is happening is post acquisition B shareholder will have more number of shares in our company. So accounting wise B has acquired A. So accounting will be done as a B acquired A. All the figures of B, assets, liability, reserve, capital of B remain same. To the figures of B, assets and liabilities of A are added at acquisition date fair value. ठीक है, तो all figures of B including reserves will remain same. Capital of B gets converted into capital of A. Assets of liability, assets and liabilities of A will be added, not the reserves, at acquisition date fair value, and difference between PC and NATO will go in goodwill or capital reserve. ठीक है, तो as it is a case of reverse acquisition, accounting is done as a B acquires A. अच्छा, now A का 1 share is worth 16 rupee and A currently has 100 shares. So don't think A acquired B, B is acquiring A. So B is acquiring A, 100 shares they are having, 16 rupee value. So I can say PC is 1600. That's fair value. So PC is 1600 हो गया. Now assets and liabilities are coming, acquisition date fair value. Normally for everything it's same, only for non-current asset it is 1500 given, fair value. So now we get a goodwill of rupees 300. Now we get a goodwill of rupees 300. Did you understand? How do I prepare a balance sheet? How do I prepare a balance sheet? So B के figures are same, assets, liability, reserve, capital, B का same. To that add the fair value of assets and liability, not reserve, of A. अच्छा, capital B का same. To A we are giving our shares. Now you might be feeling that your PC was coming as 1600, one share of B is worth 40. I should give 1600 divide by 40. I should give 40 shares. So you might be thinking B में 60 थे plus 40 shares coming, but pay attention. See, legally on paper, we accounted as if B acquired A, but on paper legally the company which acquired was A. So heading will be consolidated balance sheet of A Limited. Heading will be consolidated balance sheet of A Limited. Same way, the number of shares will be from A Limited's angle. The capital ka amount, wo B plus what we gave to A, that way it is there. But the number of shares will be writing is from A Limited's angle. Okay, so check over here. Share capital, how did you got 2200? So B ka remains same 600. To A we gave 1600, total 2200. Total 2200, and they'll be writing 250 shares. They'll be writing total how many shares? 250. The number of shares will be from whose point of view? A. Because legally A is there. That's why. But they are not bifurcating basically into equity share capital and securities premium. ICI doesn't bifurcate. We are also not bifurcating. I think there will be a note given for this. Let me just see the note. Okay, question, if they had mentioned larger entity will have a control, we need to see which has a more fair value. BX has a more fair value, they are the larger entity, fine, chalega. Okay, now going to the next last question of this chapter, I think this is question number 58. Any doubts? Question 57. Any doubts? Question number 57. Thank you. Keep smiling, pay attention. Now, question number 58, H acquired S in two tranches. Okay, acquisition in stages. So it's a step acquisition. The earlier equity interest held is to be remeasured. Earlier 15%, now 45%. You purchased it based on the quoted price going on in market. H got a control on 1st January. We got a control on 1st January. So from 1st January, consolidated financials come. Fine. Moving ahead. The balance sheet is given on 1st January only. This is of S. Balance sheet of S, subsidiary. H acquired S. Carrying amount is given, fair value is given. Oh, fair value given. So assets and liability coming in at acquisition date, fair value. That needs to be taken care. Achha, just one thing, there's a non-current asset held for sale. If you remember, non-current asset held for sale coming. If non-current asset held for sale comes under business combination, it's not valued at fair value on acquisition date. It's valued at fair value less cost to sell. It's valued at fair value less cost to sell. ठीक है? Moving ahead. Okay, following is the information given to you related to contingent liability. Acha, they showed as contingent liability. If it's a present obligation, we are able to measure reliably, we'll show it as actual liability. And if they give you fair value, means we are able to measure reliably. So there's a lawsuit filed by customer for 2 crore, fair value is 0.5, we are able to measure reliably, we'll show it as actual liability. And this will be tax deductible. This will be tax deductible in future. So today liability goes up, future it will be allowed, we create a DTA on it. Okay, there's a demand from income tax authority. Fair value 2 crore, we'll show it as actual liability. But one more thing, remember, penalties which you pay are never allowed under income tax. If they're never allowed under income tax, that will be a permanent difference. So uspe DTA, DTL will not come. So there won't be any DTA, DTL on this, but there will be a DTA, DTL on 0.5. But both I'll recognize it as actual liability in CFS. Okay, now S has given an indemnification undertaking to H up to maximum 1 crore. So we'll be recording 2.5 crore as actual liability. Opposite side, indemnification asset of 1 crore will be recognized. And indemnification asset is not taxable only. If it's not taxable, there's no DTA, DTL on that. Fine. Uske upar DTA, DTL nahi hai. Okay, carrying amount of non-current asset held for sale is 4 crore. Uska fair value 4.5 tha. Non-current asset held for sale, carrying amount 4. Fair value was 4.5. It represents, okay, the carrying amount represents the fair value less cost to sell. The fair value less cost to sell is 4 only. So I'll be including not at 4.5, I'll be including at 4. This is the fair value less cost to sell. Okay, in consideration of the additional stake purchase, additional stake which you purchased on 1st of January, what did you do? You issued 1 share for every 2 share. For every 2 shares of theirs, you're giving 1, and your 1 share is worth 10,000 rupee. Okay, on 1st January 7, H paid 50 crore in cash. Okay, the plus I'm giving cash 50 crore. Additionally, H will pay 30 crore if the return exceeds this much. This is contingent consideration. If it's a contingent consideration, the fair value of contingent consideration on acquisition date will be included in your PC. So you assume or you find out the fair value on acquisition date is 22 crore. Achha, from 22 in March it became 23, that extra 1 crore that will go in P&L. And quoted price of S when you acquired the quoted price, so you have acquired based on the quoted price only. ठीक है, तो earlier investment is to be remeasured, or remeasurement will be done based on today's rate going on. So today's rate is basically 395, you would have acquired it at a different rate that time. Now this is done. Now May, okay, when did we acquire? We acquired in January. In May it was found out certain customer relationship were there on 1st January, which met the criteria for intangible asset, but we forgot to record it. Acha, so 1st January ko there were certain intangible asset, you forgot, you came to know about it right now. So there's a new information. There's a new information based on facts and circumstances which existed on acquisition date. Acha, yaad aaya measurement window? There's a new information we get today based on facts and circumstances prevalent on acquisition date. The measurement window may I can adjust, so I can record that intangible asset. Okay, if I'm recording intangible asset, earlier it had gone in goodwill. Then if I record intangible, goodwill will automatically go down. Goodwill will automatically go down. And if NCI is at proportionate net asset, if I'm recording intangible, so proportionately some part will go to NCI people also. And difference goodwill will go down. Now fair value of that customer relationship 1st January is 3.5. And there are no temporary difference for it, so no DTA, DTL on it. And now there's some new customer relationship which has came up. New coming up is not to be accounted as per 103. वो 103 की तरह account नहीं होगा, ignore that. 30% is a tax rate for all DTA, DTL purposes. You're required to calculate goodwill or gain on bargain purchase. Then you find out NCI, etc., etc. Fine. And what will be the accounting treatment of contingent consideration? We included in PC at acquisition date fair value. Subsequent change goes in P&L. Let's find out first of all PC. Acha, for 45% which you acquired right now. Total 0.12 crore share, uska 45% you are acquiring this many shares. Exchange ratio, 1 share for every 2 shares, so you are giving this many shares of yours, and 1 share of yours is valued at 10,000, so this is coming in PC. Plus you gave cash 50 crore and there was contingent consideration whose fair value is 22. This is for 45%. Achha, earlier investment held, you remeasure it based on today's market price 395. So out of 12 lakh shares, 15% we already had. Today the value is 395. This is earlier investment held, so this becomes your PC. Okay, PC done. Now let's go to the net assets. Okay, in your net assets, the fair value are already given. PP, intangible, investment, ye all. Ye just check this, non-current asset held for sale 4, not 4.5. This is 4, not 4.5. Acha, then this contingent liability we have recorded, they did not record. We are recording 2 plus 0.5, 2.5. Indemnification asset will be recording 1 rupee. And now DTA, DTL impact. So PP may change, intangible may change, investment may change. Contingent liability may on 2 rupee it's not there, only on 0.5. For 2 rupee penalty disallowed under income tax, permanent difference. And indemnification asset also they said it's not taxable, so uspe bhi it is not there. So only on this basically 30%, 92.85 is DTL. So you put DTL also over there. The net identifiable assets and liabilities, the net assets coming are 368. Net assets coming are how many? 368. Okay, the net asset coming 368. Now let's calculate goodwill or gain on bargain purchase. The consideration was this. NCI is at proportionate net asset 368 ka 40% and fair value of identifiable net asset 368. This becomes goodwill. But this does not include that customer relationship identified in May. वो इसमें included नहीं है. Now, what happened? Within the measurement window, we found out there's some customer relationship. And वो customer relationship का value is 3.5. अच्छा, customer relationship now if I record as intangible, if I record, so asset goes up, NCI will also get a share in that asset 3.5, uska how many percent? 40%. So 1.4 will go to NCI and now opposite goodwill will reduce. Earlier we did not record in asset, it went in goodwill. Very simple, if you don't take it in net assets were lower, so difference goodwill mein chala gaya. So now if I record it, goodwill now goes down. Did you understood? Now additional customer relationship coming up, that will not be coming over here because that was not based on facts and circumstances prevalent on acquisition date, to ignore it. Contingent consideration, we had recorded it at, contingent consideration was recorded at 22. Year-end pay, the value is 23. We fair value it every year. The difference goes in P&L. That is answer C. Any doubts? Anybody with this question? Any doubts? Anybody with this question? This is your chapter of business combination. Now, what is carve in, carve out between Ind AS 103, IFRS 3? Ind AS 103, IFRS 3, first carve out. Okay, they take gain on bargain purchase in P&L. We don't take it in P&L. If reasons are clear, OCI to capital reserve. Reasons are not clear, directly in capital reserve. Acha. Then they don't have CCBC wala thing. We have added, that's why it's carve in. That is nothing but your CCBC. So this is your chapter of business combination. Moving on to the next chapter, consolidated financial statement. Moving on to the next chapter, consolidated financial statement. We'll take a break between 7 to 7:15. Abhi to we have just started na. So let's do something more and then we'll take a break. So how is this revision session? I hope you are able to understand everything and I hope the coverage is absolutely fine. If you feel anything more to be covered or if you feel that, sir, you can change this way, please feel free to tell me. And if you like our lectures, please share about our lectures to all your friends. New syllabus lecture, same, this one, are available on Yashash Academy's website. Students can buy it from yashashacademy.com. And I tell you, our lectures are exhaustive. Students don't have to do anything else. It covers all ICI questions, RTP, suggested answers, everything. Thank you. Okay, chapter number 13, consolidated financial statement. We have many units. Unit number 1 is just the introduction. We know there are 3 types of financial statement. One is called as the individual, second is called as your separate financials, and third is called consolidated financial. Okay, what is the individual financial statement? The individual financial statement are the financial statement of an entity which does not have a subsidiary, associate or JV. If you don't have a subsidiary, associate, JV, your financial statements are called which one? The individual financial statement. Just a minute, what happened? They are individual, which do not have subsidiary, associate, JV. It's a separate financial statement. Separate financial statement are the financial statement of an entity. Okay, they have a subsidiary, associate, JV, but that subsidiary, associate, JV is measured. That subsidiary, associate, JV is measured as per Ind AS 27. Okay, it is measured as per Ind AS 27. That is either at cost or in accordance with Ind AS 109. So that is basically a separate financial statement. Okay, consolidated financial statement are the financial statement of a group as a whole. And wahan pe you have parent plus subsidiary plus associate plus JV all together. That is called as a consolidated financial statement. My keyboard is not working. Okay, fine. Okay, now moving ahead, why do we need a consolidated financial statement? Why consolidated financial statement are required? In your separate financial statement, you are showing investment in subsidiary, associate, JV normally at cost. You're showing investment in subsidiary, associate, JV normally at what rate? Cost only. If I show them at cost, what is going to happen? It doesn't reflect the true worth. It doesn't reflect the true worth of basically my investment, and that's the reason we need a CFS. So just hold on, I am getting one important call, to just 1 minute. Okay, so if you just check out over here, we have 80% investment in the subsidiary. It is at cost 100 rupee. But if I just go by net assets only, the net assets of subsidiary 1200 minus the liability 200, asset minus liability, can I say 1000? 1000 ka 80%. Just by net asset also, if I go, the worth of my investment is 800. This, if I go by net asset only, the worth of my investment is how much rupee? 800, but I'm showing it at cost only 100. It doesn't reflect the true picture, and that's why we need a CFS. Now, what is the component of CFS? Consolidated balance sheet, P&L, consolidated statement of changes in equity, consolidated cash flow, as well as your notes to accounts. ठीक है. Now, all notes which are there in your SFS need not again be given in your CFS. So, sir, which note should I give in CFS? Which note should I give in CFS? So I need to give basically the disclosures which are required as per Schedule 3. That's one. And number two, those disclosures which are going to help the users understand the consolidated financial statements properly. The one which are relevant to consolidated financial statement, that only needs to be given. Only the notes which are material, help in presenting a true and fair value of CFS are to be included. Fine. This chapter, what is going to be covered? It's just an introduction. So we'll have Ind AS 110. Ind AS 110 is on consolidated financial statement. How do we consolidate a subsidiary? Then we have Ind AS 111, joint arrangement. So whether there's a joint control or not, we learn over here. And if it's a joint arrangement, if joint control is there, it's called joint arrangement. Joint arrangement can be either a joint operation or a joint venture. Okay, then we'll learn Ind AS 28. Ind AS 28 is investment in associates and JV. How do we determine whether we have a significant influence? So whether significant influence is there or not, we learn in Ind AS 28, plus how to account for associates and JV in your CFS. Associates and JV in your CFS, they are accounted by equity method. Equity method we learn over here. Achha, Ind AS 27 is on separate financial statement. How do we show investment in subsidiary, associate, JV in your separate financial statements? And lastly, Ind AS 112 relates to the disclosure. Okay, so this is basically what we are going to learn under this chapter. Ind AS 110, Ind AS 111, Ind AS 27, Ind AS 28, Ind AS 112. These are things to be learned. Okay, this is about AS given, not relevant. Unit number 2 is just the definitions, not relevant. Come directly to unit number 3. Come directly to unit number 3. Aisha says, sir, can you do consolidation question number 23? Aisha, just tell me when that question comes. Consolidation question of November 23. Dear, I've already taken a session on basically the suggested answers. So November 23 exam ka I had taken basically a session. You can just refer over there. In case you are having any doubt, you can please DM to me. So there's already a separate session taken by me on all the RTPs as well as the suggested answers. So November 23 exam ka session, you can just go through it, and then if you have any doubts, you can ask me back. Okay, now going to unit number 3, Ind AS 110. We'll be learning over here the word control. Yeah, word control, the control is there, not there. Uske related this thing is basically Ind AS 110 is there. Okay, the first of all, is it mandatory? Is it mandatory to prepare a consolidated financial statement? So section 129 of your Companies Act. Section 129 is on financial statement. As per section 129 subsection 3, where a company has one or more subsidiary or associate, you either have a subsidiary or associate. Associate includes JV also. Associate includes JV also. It shall mandatory. In addition to own financial statement, you're also required to prepare a consolidated financial statement. Okay, so as per your Companies Act, CFS is mandatory if you have a subsidiary, associate or JV. Okay, sir, I don't have a subsidiary, I have only associate. I don't have a subsidiary, I have associate. Do I still need to prepare CFS? Answer is yes, you still need to prepare CFS. Sir, is there any exemption for preparing CFS? So Companies Act has given one exemption. Companies Act has given how many exemption? One. Okay, so for that exemption, you just check the condition. 3 criteria are given. It's a wholly owned subsidiary or a partly owned subsidiary of another company. As such, you are a parent. As such, you are a parent of someone, but you are also a subsidiary of someone. You are either a wholly owned or a partially owned subsidiary of someone. And if it's a partially owned subsidiary, the other members So you are coming in between. You are coming in between. The other members are not objecting for you not preparing CFS. The other members have been informed in writing and they do not object of company not preparing CFS. Plus, you are not listed or in process of listing, whether in India or outside. Any of your security, shares, debentures, ADR, GDR, nothing is listed in India or outside India. And the ultimate, so you are falling in between. Aapke upar wala, they prepare CFS which are based on basically AS or Ind AS, whatever is applicable, and they are filed with ROC. So they basically file the CFS with ROC which are based on the applicable AS or Ind AS. So see, A limited, B limited, C limited, who is coming in between? B. So B is exempted. B is exempted provided the three criteria are fulfilled. B is unlisted or not in process of listing. The other shareholders in B. Okay, if A holds 100%, तो problem नहीं है. But if A holds 80, तो can I say there are other shareholders in B? The other shareholders in B do not object of B not preparing CFS. Clear? And the ultimate A should be preparing CFS, that is required. Then basically B limited is exempted. Okay, this was given under Companies Act. Okay, now coming to AS21. AS21 doesn't tell you when to prepare CFS. They're just telling if you are preparing CFS, prepare as per AS21. So when to prepare, they don't say. But AS21 is given 2 exemption. AS21 is given how many exemption? 2. Whenever the control is temporary, I acquired with a view to sell it off within 12 months. Imagine I acquired 60%, but I'll sell it off within 12 months. So control is temporary, don't consolidate such subsidiary. Or if a subsidiary operates under a severe long-term restriction which significantly impair your ability to transfer funds to parent. So if subsidiary is operating under severe long-term restriction, I told you subsidiaries in China, India, China, suppose not at good terms, so I won't be able to control them. It operates under a severe long-term restriction, then don't consolidate such subsidiary. So AS21 doesn't tell you when to prepare CFS, they're just telling if you are preparing CFS, prepare as per AS21, and they have given some 2 exemptions. Now going to Ind AS, what does Ind AS say? So Ind AS 110 says each parent is required to present CFS. So if you are a parent, you have to prepare CFS mandatorily. If you are a parent, you have to prepare CFS mandatorily. Now, A LLP holds 60% in B. So, A LLP is a parent. A LLP is a parent. Now, Companies Act doesn't apply to LLP. Ind AS also doesn't apply to LLP. So, whether A LLP has to prepare CFS, not mandatory. Whether A LLP has to prepare CFS, not mandatory. You are a parent, but thing is, Ind AS doesn't apply, Companies Act doesn't apply, and AS21 doesn't tell you when to prepare. Okay. Now, is there any exemption given under Ind AS 110? Yeah, the Ind AS 110 mein there's first exemption which is similar to Companies Act, wo intermediate wala. That is similar to Companies Act. Achha, second exemption is for investment entity. If you are an investment entity, you are not required to prepare the CFS provided you measure all your investment in subsidiary associate JV at fair value through P&L. The investment entity is exempted provided you measure all your subsidiary associate JV at fair value through P&L. And third, entities which are created for post-employment benefits for employees. Achha, post-employment benefit for employees, wo Infosys created Infosys Gratuity Trust. Infosys controls Infosys Gratuity Trust, but that is not to be consolidated because the benefit is basically for employees, not for you. I hope this is clear. Okay, now coming to question number 1, it's important, pay attention. X has a subsidiary A has 2 subsidiary B and C. Now, so who is falling in between A? So A can go for that intermediate exemption. When A can go for intermediate exemption, provided A is not listed, not in process of listing, whether in India or outside. Okay, that's one thing. Second, the other members of A. Now, यहाँ पे A is 100% owned by X. So there are no other members. So other members है ही नहीं. So that point doesn't come up. And company X should be preparing financial statement which are filed with ROC and they are as per the applicable AS or Ind AS. ठीक है, तो company X is listed, X listed है and prepares CFS as per Ind AS. A is unlisted. X does not object A for not preparing CFS. Whether A is required to prepare CFS, no, they can go for exemption. Same fact, except company X is a foreign entity. If company X is a foreign entity, oh baapre, then they don't prepare financial statement as per Ind AS which are filed with ROC. So now The ultimate one is not preparing financials which are filed with ROC. So now in that case, company A cannot get exemption. तो फर्स्ट वाले में कंपनी ए इज नॉट रिक्वायर्ड टू प्रिपेयर सीएफएस, सेकंड वाले में कंपनी ए कैन नॉट अवेल एग्जेम्पशन, दे हैव टू प्रिपेयर सीएफएस. And third may assume the same thing, but instead of company A, it is Mr. X. Okay, it's not company A, it is Mr. X. So Mr. X has a control over basically investment in company A is held by Mr. X, not company X. Company X nahi hai, it's Mr. X. Mr. X to company A. So now Mr. X doesn't have to follow Ind AS. Mr. X does not have to file with ROC. So then in that case, company A cannot take the exemption, they have to prepare CFS. So यहाँ पे भी cannot avail exemption in the C point also. Okay, moving ahead, second question, that's also important. Company A has two subsidiary B and C, and C has a subsidiary X. अच्छा, तो who is the intermediate one? ये C. A to C, C to X. A to C, C to X. अच्छा, A is listed, they prepare CFS. C is unlisted. C is unlisted. 60% of C is held by A. Balance 40% is by outside investor. अच्छा, तो कहने से यहाँ पे 60% is by A, balance 40% is by outside. So that 40% people should not object of C not preparing CFS. So whether C is required to prepare a CFS, answer is no if that 40% don't object. Okay, so check out. So C should inform the 40% shareholder, and if they do not object, C can avail exemption. Now, second question, same scenario, balance 40% in C is held by B. Okay, balance 40% in C is held by B. यहाँ पे ये 40 हो गया. So now in that case, can I say A holds directly 60 in C, and via a wholly owned subsidiary they are holding 40. So now in that case, indirectly C is a wholly owned subsidiary of A. 60 directly, 40 via B indirectly. So now in that case, C is wholly owned subsidiary of A. Now I don't have to inform others. There are no others. तो फर्स्ट वाले में इन्फॉर्म करना था, यहाँ पे यू आर नॉट रिक्वायर्ड टू इन्फॉर्म अदर्स, तो यहाँ पे यू आर नॉट रिक्वायर्ड टू इन्फॉर्म B because it's indirectly a wholly owned subsidiary. It is wholly owned subsidiary, approval of other shareholder not required. Partly owned subsidiary, approval of other shareholders required. Okay, going to question number 3. Okay, PQR has 100% in AB as well as 100% in BC. Now AB holds 60% in XYZ, BC holds 40% in XYZ, and XYZ has a subsidiary RST, which is an intermediate one. They're talking about here XYZ intermediate. Actually, this AB and BC are also intermediate, but they are talking about XYZ. So whether XYZ can avail exemption, so can I say XYZ is indirectly a wholly owned subsidiary of PQR. XYZ is indirectly a wholly owned subsidiary of PQR. So then in that case, no need to ask to other people. They can avail exemption. And suppose instead of PQR it was Mr. X. So now XYZ is a subsidiary of AB. AB holds 60%. So then they have to take permission of BC. So they have to inform BC. If BC agrees, then only they don't prepare CFS. So first case में in scenario 1, it's a wholly owned subsidiary of PQR. You are not required to take permission of someone else. So wholly owned subsidiary not required to inform anyone else. You can take the exemption. But second scenario mein, if it was not PQR Limited, if it was Mr. X, so now in that case what happens is, so you are basically a subsidiary of AB. AB holds 60%, BC holds 40, so other shareholder BC have to inform and take permission. So now you are not a wholly owned subsidiary of anyone. So you are required to inform the other shareholder, BC Limited should be informed. If they do not object, then you can go for the exemption, not preparing CFS. Any doubts? Anybody till now? Any doubts? Anybody till now? Okay, moving ahead to the word control. Control, किसको बोलेंगे? Now first, as per AS. As per AS, control is what? If you own directly or indirectly. Indirectly is via subsidiary, not via associate or JV. Indirectly is via subsidiary, not via associate or JV. If you own directly or indirectly more than 50% of voting power, or is written, so any criteria fulfilled, you have a control, or you control the composition of board of directors of the entity. So then in that case, so as to get economic benefit, you control the composition of board of directors so as to get economic benefit. Now, is it possible? A limited hold 60% in B, A limited holds 60% in B, and Z limited hold 40% in B. A holds 60, Z holds 40. But now, the power to appoint majority BOD is with Z. As per agreement, the power to appoint majority BOD is with Z. So now, based on voting power, A holds more than 50. And based on the second composition of BOD, Z controls the composition of BOD. So now in this case, B will be regarded as subsidiary of A also, B will be regarded as subsidiary of Z also. So here it is possible that the entity is controlled by two enterprises. One controls based on virtue of voting power, other control based on virtue of the composition over BOD. Fine. And under your AS, the potential voting rights are not considered, because the potential voting rights, they are not having voting power today, so that is not considered. Right to buy shares in future, that is not considered. But under Ind AS, if that right is a substantive right, we consider it, it will come, don't worry. Now, control as per Ind AS. Control as per Ind AS 110. Under Ind AS 110, when do I say we have a control? The investor has a control over investee if and only if all the following conditions are present. Investor controls investee if and only if all the following conditions are present. 1. You have a power over investee, able to take decisions unilaterally. Second, you have an exposure or right over variable returns. Exposure right to what? Variable return, because of your involvement with investee, and you can use your power to influence the return. So they nowhere they say you hold 50%. So over here, determination of control is based on principle. You need to see it's a principle based. It's not a rule based, it's a principle based. Sometimes with even 40% holding. If other shareholders are small, they don't come and attend meeting. So in a meeting, only the shareholders holding total 60% is present. Out of that, you hold 40. You are able to take decision whichever you want. So sometimes with 40% also, you may have a control here. So they just say you should have a power over investee, exposure or right to variable return, and you can use your power to influence return. So it's basically a principle based. We need to check out the relative holding size of others, whether they come and attend meeting. I need to see the contractual agreement. Sometimes I have 60, I'm holding 60, but I have an agreement with minority people that without their approval, I'll not take any decision. Okay, without their approval, I can't take any decision. Even with 60% control is not there. Potential voting right, they are considered if they are substantive. So this all other things are also to be considered. Okay, whether potential equity shares are considered. So if they are substantive, then in that case you are taking it. Now whether it's substantive or not, it will be coming up later. वो बाद में आ रहा है. ठीक है, तो 3 points were there. You should have a power over investee, exposure or right to variable return. You can use your power to influence the return. Now what do you mean by power over investee? What do you mean by power over investee? So you have an existing right. You have an existing right that gives you a current ability to direct the relevant activities of investee. So you have an existing right that gives you a current ability to direct the relevant activities of investee, and relevant activities are those which significantly affects the returns of investee. So activities which significantly affect investee's return. So if the relevant activity or activity which significantly affect investee's return, examples are given, that's okay. Okay. Now, when do I say I have a current ability to direct the relevant activity? When do I say I have a current ability to direct the relevant activity? So I am able to take the decisions whenever decisions are to be taken. So current ability means investor will be able to make the decision at the time decision needs to be taken. So imagine decisions can be taken only in a meeting. Achha, and meeting can be held by giving a 21 days clear notice. Okay, the 21 days clear notice is to be given, and I have some options which can be exercised in 15 days. Okay, the decisions can be only in a meeting can be minimum after 21 days and have option which can be exercised in 15 days. So that right will be a substantive right. You can exercise before the meeting comes. So whenever decisions are to be taken, you will be able to take decision whichever you want. Okay. Now, moving ahead. Rights are of two types, substantive right, protective right. Rights are of two types, substantive right, protective right. Substantive rights are considered while determining power. Protective right are for your protection. They are not considered while determining power. Acha, to substantive right are considered for determining power, control, and protective rights are not considered while determining control. So substantive right gives the power to investee. Protective right do not give power to investee. Substantive right relate to the relevant activity of investee. Protective right are only to protect the interest of the party holding that right. Okay, for a right to be substantive, when do I say it is substantive? You should have a practical ability to exercise it. Right to be substantive, you should have a practical ability to exercise it. Now imagine, I have a right to buy extra shares. And before AGM come, I can buy it. But I have to pay 5 times the market price. If I have to pay 5 times the market price, would I exercise? No. Then that right is worthless, then it is not substantive. But if I have to pay a small premium to get control, small extra premium to get control, I might be ready. Then it is still a substantive right. If I have to pay heavy penalty or if I have to pay extra price, then it is not a substantive right. The barrier that prevent the holder from exercising right, penalties, high conversion price, etc. And to be substantive, it should be exercisable when the decisions about the relevant activities are to be made. So substantive ke liye, it should not be like exercisable today. It's not necessary it should be exercisable today. It should be exercisable when the relevant decisions are to be taken. I told you if decision is taken in a AGM, there's a meeting required, meeting mein 21 days clear notice. So if it is exercisable within 21 days, chalega. It's fine. Okay, moving ahead. Okay. Protective right. Protective right are designed to protect the interest of the party holding that right without giving power to that entity. Okay, when I take some franchisee, they say you have to wear uniform, you have to basically put this kind of signboard, you have to have this type of furniture. That's okay. They cannot manage my business. That was basically to protect the image of the franchisee owner. Jo main franchisee owner hai na, to protect their image. And that's why that is just a protective right given to that franchisor. The franchisee who has taken this franchisee, that guy is basically having the control. One who has given the franchisee just as a protective right. He doesn't have control. So check out in a franchisee agreement, the investee, the franchisee usually gives franchisor the right that are there to protect the franchisee brand. Now they are just basically your protective right. It doesn't give the basically the franchisor the control over franchisee's business. It doesn't give control to franchisor. The control remains with the franchisee only basically, and wahan pe jo company who has given that franchisee right, they just have a protective right. Okay, so protective right of franchisor. ABC Limited is a manufacturer of branded garment. They own brand X. And there's a franchisee agreement and you are setting up a retail outlet. You are setting up a retail outlet. You'll be selling product brand X. PQR will set up a retail outlet, own fund, decide the capital structure, hire employee, remuneration, select vendor for capital items. There are certain SOPs to be followed. Retail outlet may uniform, interior, but they are just to protect the brand image. So that doesn't give control to the franchisor. The control remains with franchisee only, that's PQR Limited, not with ABC. Clear? Okay, power through voting right. If you have majority, so generally you have a control. If I am having more than 50%, generally control is there. Sometimes with more than 50% also control may not be there. If I have a contract with minority, that I will not take any decision without their approval. If I will not take any decision without their approval, then in that case, even with 50%, I don't have a control. Sometimes with less than 50% also I may have a control, because there are others, lakhs of small shareholders, they don't come and attend meeting. That way it is there. Fine, moving ahead. Okay. They said you should have a power over investee. Done. Power over investee. So you have basically the existing right that give you the current ability to direct the relevant activities of investee. Second word is you should have exposure or a right to variable returns. Exposure or right to variable return. So returns should not be fixed. Imagine if I have a debentures, of that company I've invested, I can never have a control there, because I don't have exposure to variable return. To have a control, you should have exposure to variable return. And sir, kitna exposure? I hold 1% equity, chalega? So generally no. So you need to understand, you have a exposure to variable return. Variable returns are not fixed. They can be positive or negative or both. And you need to just check out whether it's a variable return or not, and link between power and return. So the third condition was you can use your power to influence the return. Now see, sometimes percentage of profit is given to manager, or percentage of profit is given basically the one is handling the business also. So employee को भी percentage of profit is given. So if you have a right over some percentage of profit, that doesn't make you a owner. And see, control always will be with owner. Principal has a control. Agent doesn't have a control. So I need to understand whether you are acting as a principal or whether you are acting as an agent. Agent never controls the entity. Principal controls. So if you are taking any decisions, I need to understand whether it's capacity as a owner or whether it's in capacity as employee. Okay, rights of other people. Can the other people remove you? Remuneration, what you're getting, like some percentage of profit given to you, that can be given to employee also. So based on all that things, we decide whether you are an agent or whether you are a principal. Okay, there are so many questions related to fund manager. Okay, so whenever there's a investment fund, the fund manager takes the decision. Who is taking the decision? The fund manager is basically taking the decisions, where to invest, how to invest, all that things. So all relevant activity, the decisions are taken by whom? The fund manager. All relevant activity, the decisions are taken by whom? The fund manager. So you might say, oh sir, fund manager is taking all decision, he controls. But yeah, I need to understand, he's acting as principal or agent. So normally that fund manager is getting some percentage of profit or percentage of asset managed. So wo acting as an agent. But imagine the fund manager himself owns equity. Okay, fund manager himself owns the equity in the company. So then I say, okay, he also owns the equity in the company, but he should have how much exposure? He should have 20% or more. If fund manager owns 1% equity in the company, nay, or 2% equity in the company, nay, 20% or more is required. Okay, the check over here. There's a fund manager, he will take all the decisions, and he has a 10% investment in the fund. 10% investment in the fund. Uska fees is 1% of net asset value managed. Okay, so now whether fund manager controls the fund, so over here, what is happening is the fund manager has 1%, wo to employee ko we give it, but he has some 10% pro rata investment. So whether that exposure to variable return is sufficient, so they are telling no. 20% or more. So consideration of fund manager exposure to variability of return together with decision making authority indicates fund manager is an agent. He cannot control the fund. So ICAI considers 20% or more investment in fund in order to have a sufficient exposure to be called as principal. In this question, he holds only 10%. अच्छा, यहाँ पे second वाले में he gets fee 1% of net asset and 20% of some surplus profit. Determine whether he has a control when he has 2% investment in fund. Investment 2% in fund? No. Achha, when he has more substantial pro rata investment, assuming 20% or more. So yes, but the investor can remove fund manager by simple majority, but only for breach Bridge करेगा, we can remove, that's a protective right. Bridge करेगा, we can remove protective right not considered while determining control. तो इसको भूल जाओ, don't consider. So if he has more substantial pro rata investment 20% or more, then in that case yes, he has a control. यहाँ पे 20% investment is there, but fund manager is appointed annually. Board may decide not to renew his contract. So can I say he can be removed? So if he can be removed, so now in that case I can't say he has a control because he can be removed by the other board members. So first may he does not control, second may yes he controls, second may he controls, third may he does not control because the board manager can remove him, board people can remove him. I hope this is clear. So whether he's acting as a principal or agent, I need to understand the scope of decision making authority, whether he can be removed by others, the remuneration what he is getting, all that things I consider and decide whether it's an agent or a principal. ठीक है, moving ahead. Question number 19. Question number 19. Okay, Angel Limited has adopted Ind AS and it has made investment in equity share of pharma, and the shareholding pattern is given. You made an investment in which company? Pharma Limited. Okay, you hold 21%. You hold 21%. Little Angel, I assume it's your subsidiary. Your subsidiary holds 24%. So you hold 21, your subsidiary holds 24, directly plus indirectly 45% holding. Then there's some Wealth Master Mutual Fund. There are some individual shareholders. Okay, note number 4, if I see for individual shareholders 17,000, small thousands of shareholder, nobody holds even 1% also. Okay, now past AGM ka data is given. Past AGM ka data, Angel Limited attended and voted, attended and voted, attended and voted. Little Angel voted as per your direction, as per your direction, as per your direction, because वो आपका subsidiary था. So you hold 21 plus subsidiary holds 24, so you hold indirectly 45. Okay, out of 52%, only 7% attended, 8% attended, 6% attended. So can I say whenever meeting is being held, we are 45, mutual fund is 3, and others may 7-8% attend. So total in all 60% shareholders are attending. In 60% we hold 45. 60 may say we hold 45. The track record we have seen. So do we have a control? Answer is yes. Even with this 45% we have a control. Others are small people not coming and attending. Okay. Plus pharma has taken a loan from bank, and as per the agreement, the pharma will require approval of bank. Approval of bank is required for payment of dividend, buyback, extra borrowing, amalgamation. So right held by bank is protective. Bank is not interfering in day-to-day operation. It is interfering where you go for amalgamation, extra borrowing, dividend payment. So few things. So bank ka right is a protective right. ठीक है. Recently board proposed a dividend 5, bank ने reject किया, ठीक है. Now under IGAP, AS में it was an associate. Under accounting standard it was associate. Ind AS में how to treat it? It will be a subsidiary. So definition you explain and then you explain each point. Power में basically यहाँ पे it's called a de facto control. If you have less than 50% but still you have a control. If you have less than 50% but still you have a control, उसको बोलते हैं de facto, based on facts and circumstances. De facto control. So there's a de facto power which you are having based on facts and circumstances, because people don't come and attend meeting. The meeting held, 60-65% shareholders attending. We hold 45 in that. We have a right or exposure to variable return by way of equity stake. We can use our power to influence the return. Yes, that is there. The rights held by bank are just a protective right, will not be considered. So here Angel has a control over pharma. Clear? Control over specified asset is fine, not required. Continuous assessment is fine. Coming to the point, investment entity. Coming to the point, investment entity. Okay. We know that investment entities are exempted investment entities are exempted from preparing what? CFS, provided they carry their investment in subsidiary, associate, JV at fair value through P&L. Now, who is called as an investment entity? Okay, I am a company, and what do? I invest my funds. If I am investing my funds in different companies, I am a company, I invest my funds. मेरे funds I invest in different entity. Am I investment entity? No. Investment entity, they take money from someone and they manage that money. किसी का पैसा लेके I am doing investment on their behalf, that's an investment entity. Okay, so to decide whether it's an investment entity or not, 3 conditions. All 3 has to be satisfied. 1, you obtain funds from one or more investor for providing those investor with investment management services. 2, you commit to investor that the returns will be the returns is solely for by way of capital appreciation, investment income. So you commit to investor that your business purpose is to invest solely for capital appreciation, investment income both. And third, those people who have given you money, you would have invested. The investments, whatever you have done, you will measure it on fair value basis. You measure and evaluate performance on all investments on fair value basis. 3 conditions. You obtain funds from one or more investor with a view to provide them investment management service. You're committed to investor. What you're committed? That your business purpose is solely to earn income by way of capital appreciation, investment income, or both. And third, you'll measure all your investments based on fair value. All 3 has to be satisfied. Achha, if all 3 conditions are satisfied, then we go to characteristic. All 3 conditions satisfied. Now we go to 4 characteristic. Okay, 1. Is there more than one investment? It should not happen I'm investing only in one company. So there should be more than one investment. There should be more than one investors. Investors are not related, and those who have invested, I've given them my equity share. Those who have invested in my company, I've given them my equity share, or I've given them units. Like whenever you invest in mutual fund, can I say mutual fund people give you unit? ठीक है. So first 3 conditions. If 3 conditions fulfilled, go to 4 characteristic. 4 characteristic में more than one investor, more than one investment, investors are not related, and entity has ownership interest in form of equity or other similar nature. ठीक है. Now what if there's only one investor? Now what if, see, conditions mandatory. If 4 characteristic में, if any of them is not satisfied, then you still go by substance over legal form. Imagine you today have only one investor, but you started this investment company. अभी आपने start किया, you have just one investor. Slowly and gradually investors are coming. अच्छा, today I have just one investment. Slowly and gradually we are diversifying. Today it's only a related investor. Today my papa gave money to my company, but I'm trying. So then in that case it's okay. Conditions mandatory. Characteristic 4. If all fulfilled, pakka investment entity. If 1 or 2 are not fulfilled, whether it's an investment entity or not, go by substance over legal form. Okay, so check. The step 1, in simple word, if any of the 3 conditions not met, not an investment entity. So conditions mandatory. If all 3 conditions met, then you go to characteristic. If all characteristics are met, pakka investment entity. If 1 or 2 characteristics are not met, still it can be investment entity based on substance over legal form. ठीक है. And I tell you, investment entity exempted, not the parent of investment entity. Okay, moving ahead. Okay, investment entity will necessarily have exit strategy. See, if you are investing a redeemable debt, if you are investing in government bonds which are to be matured after certain years, वहाँ पे redemption है पक्का, the exit is there. But if you are investing in equity, so you should have an exit strategy. If you don't have an exit strategy, you are not a investment entity. So they need to have exit strategy. But if one investment entity invest in other investment entity, if one investment entity is investing in another investment entity, then that you don't need a exit strategy. ठीक है. Exit strategy mandatory. अच्छा, plus earning. Remember there was a point condition में you're committed to your investor that your business purpose is to earn income solely by way of capital appreciation, investment income, or both. So you should be having income by capital appreciation, investment income, or both. If because of your investment you are getting some other benefit or your group members are getting other benefit, then you are not an investment entity. So because of your investment, you are getting other benefit, or your group members, your subsidiary, associate, JV, parent, they are getting some other benefit, then in that case, you are not an investment entity. Okay, so check this question. Actually, PQR is an investment entity. They've invested in pharmaceutical company. Now, if any pharmaceutical company ka product becomes a hit or approval they get, so right to distribute goes to your subsidiary. So I have invested in pharma companies. If that pharma company ka product gets approved, uska right to sell goes to my subsidiary. So can I say my group member is getting some other benefit? I will not be regarded as investment entity. So group member getting other benefit. Group member getting other benefit, not allowed. Okay, now exemption to investment entity. Exemption to investment entity. Investment entities are not required to prepare a CFS provided they carry their investment in subsidiary, associate, JV at fair value through P&L. Okay, but now this is important. Ye check karo this line. If investment entity has a subsidiary, which is not an investment entity, whose subsidiary is not an investment entity, but whose main purpose and activity are providing services related to investment entity's investment activity. Acha, so I have a subsidiary which is not an investment entity, but they do work which is relevant to me. Like investment entity needs to do a research before investing. Rather than doing research on my own, I have a subsidiary doing research for me. Then that subsidiary needs to be consolidated. So usko I measure it at fair value through P&L. No. So if I have a subsidiary which is basically doing my work only, mere work ke liye, it was not really investment. वो really investment नहीं है. I have created a subsidiary to have a part of my work getting done over there. That subsidiary needs to be consolidated. So it shall consolidate that subsidiary. ठीक है. Now check over here. This is an investment entity. Investment entity is exempted from preparing CFS. A parent of investment entity is not exempted. Investment entity exempted. Parent of investment entity, they have to consolidate everything, including their subsidiary, which is an investment entity. So investment entity exempted. Parent of investment entity is not exempted. Okay, check question 25. Okay, PQR Limited is a non-investment entity. They have a 100% subsidiary, which is an investment entity. Now see, investment entity exempted. Ye parent PQR ko no exemption. PQR no exemption. They have to consolidate everything. PQR ko no exemption. Now XYZ is an investment entity. They have an exemption. They have two subsidiary. But one subsidiary is carrying on services related to your business. If that one subsidiary is carrying on activities related to your business, that has to be consolidated. The XYZ has to consolidate A. They may not consolidate B. They can measure B at fair value through P&L. So if XYZ goes for investment entity exemption, PQR ko no exemption only. If XYZ goes for investment entity exemption, they don't have to consolidate B, but still they have to consolidate A. But there's one more option. XYZ can go for that intermediate subsidiary wala exemption. If XYZ goes for intermediate subsidiary exemption, then they don't have to prepare CFS only. Okay, so from PQR, there is no exemption. From XYZ, it has to consolidate A, measure B at FBT P&L if investment entity exemption is taken. However, if they go for that intermediate wala exemption, if XYZ opts for that intermediate parent exemption, then it does not have to prepare CFS at all. Fine, moving ahead. Accounting for change in investment entity status. Accounting for change in investment entity status. Okay, you were an investment entity. Now you are no longer investment entity. If you were an investment entity, you are not preparing CFS. You were an investment entity, you are not preparing CFS. You had investments which were measured at fair value through P&L. I had investments which were measured at FVT P&L. Now, if I cease to be investment entity, can I say I have to consolidate? Okay, if I have to consolidate, net asset comes in, NCI comes in, My investment goes away. Difference is goodwill or capital reserve. So net asset comes in, NCI comes in, investment goes away, difference is goodwill or capital reserve. Did you understood? Investment going away, today's fair value. Investment going away, today's fair value. ठीक है. Now, check this question. You cease to be investment entity from 1st April 1. A carrying amount of investment which was measured at FVT P&L, today the investment is 4 lakh. Investment goes away. Carrying amount of NCI, fair value of NCI is 450, net asset is NCI is 1 lakh, net asset is 450. Okay, so what happens? Net asset comes in debit. NCI comes in credit. Investment goes away, credit, difference is goodwill. Simple. Now, you become investment entity. If you become investment entity, earlier you were consolidating. Now you don't have to consolidate. The net asset goes away. NCI goes away. Goodwill capital reserve recorded earlier goes away. Investment comes in at today's fair value. Difference goes in P&L. Okay, so now you become investment entity. So earlier you were consolidating, now you don't have to consolidate. Net asset goes out, NCI goes out, goodwill capital reserve recorded earlier goes out, investment comes in today's fair value, difference put it in P&L. Clear? Check question number 27. Check question 27. You purchased a 100% subsidiary for 20 lakh where the fair value this, all that. And the goodwill 4 lakh was recorded. Now you become investment entity. Now you are becoming investment entity and the investment ka value today is 25 lakh. So what happens is it was a 100% subsidiary. So no NCI. Okay, net asset 16 lakh was that time. Net asset 16 lakh was that time. Today the net asset is 19 excluding goodwill. Net asset 19 goes away, credit. Goodwill 4 goes away, credit. NCI to tha hi nahi. NCI tha. Investment comes in 25 lakh. Difference 2 lakh will be gain coming in P&L. So net asset, goodwill goes away, investment comes in, difference is going in your P&L. Okay, question number 28, November 21 exam. Just pay attention. Question is not from CFS angle, SFS angle se पूछा. Okay, PP Limited, non-investment company. Non-investment company is a parent of Praja Limited. The investment in Praja is carried in your SFS at fair value with changes in fair value recognized in OCI. Okay, so PP Limited has an investment in Praja. We are carrying it at fair value through OCI. Now, 1st April, you qualify as an investment entity. Okay, if you qualify as an investment entity to get an exemption from consolidation. To get an exemption from consolidation, can I say you need to now measure it at FBT P&L? So till now, you are measuring it at FBT OCI in your SFS. CFS mein you are consolidating. SFS mein it was FVT OCI, now onwards it will be FVT P&L. To fair value it right now, difference take it in P&L. Okay, fair value is 10 lakh. Fair value is 10 lakh. Book mein value is 8 lakh. Book mein value 8 lakh. Today the fair value 10. Now fair value it as per FVT P&L kar do. 2 lakh take it in P&L. 2 lakh take it in P&L. Now there is no investment carried through OCI. We don't have any investment FVT OCI. Now it's FVT P&L. The earlier OCI related balance. The earlier OCI ka balance was 1 lakh. You remove it. There's no investment now shown as FVT OCI. So related OCI balance should also go away. So we have a related previous fair value increase 1 lakh. If it's an item, equity instrument through OCI, it was an item not reclassified to P&L, take it directly in retained earnings. Okay, so 8 becoming 10. Now it is fair value through P&L in your SFS. 2 lakh goes to P&L. Now earlier OCI balance, it's item not reclassified to P&L, take it in retained earnings. Okay, the checkout. So now carrying amount is 10. 2 lakh goes in P&L and that 1 lakh OCI will be transferred directly to retained earnings. Any doubts? Anybody with unit number 3? Any doubts? Anybody with unit number 3? Okay, unit number 4, I'm starting after the break. Okay, so we finished today what? We finished the chapter of business combination, which we started. And then we have started with consolidation. Unit number 1, 2 and 3 are over. Unit number 4, I'm starting after the break. We take a break of 15 minutes. It's 7 hours, 11 minutes. There's a break, 15 minutes. We'll be back. 1 minute. Back at 7:12 to 27. Back at 7:27 p.m. Aja, where is it? Okay, 7:27 will be back. Enjoy your break till then. Chalo. Okay, hi, welcome back. Give me high five, thumbs up, everyone. We finished chapter of business combination, unit number 1, 2, 3 in consolidated financial statement. Now we are going for unit number 4. Keep smiling, pay attention, have lots of water. Okay, now let's go for this consolidation process. We are understanding consolidation of subsidiary. How do we consolidate a subsidiary? So see, consolidated balance sheet, how do we prepare? First of all, just remember, consolidation starts whenever you get control and consolidation will stop whenever the control goes away. Okay. Consolidated balance sheets, very simple. To the figures of parent, the figures of subsidiary will be added. It's item by item basis. Now you are entitled only to your share of net asset. You are entitled to 80% net assets, but you include their 100% assets and liabilities, and that's why the remaining 20% we need to show it as NCI. We know NCI can be shown either as what? Proportionate net asset, or it can be shown as what? Fair value of NCI. So from your SFS, see, CFS are always prepared from SFS. There's no separate set of books of accounts for CFS. So from your SFS, investment in subsidiary goes away, the assets and liabilities of subsidiary comes in. At acquisition date, fair value, it will come in initially. And we are entitled only to 80%, but we have included 100%. We'll be having NCI, which is coming up. Fine. NCI, how it is based, we already learned it under your Ind AS 103. Now, the thing is, you might have paid more or less. The difference will come in your goodwill or gain on bargain purchase. And similarly, if NCI is at fair value, see, if NCI is at proportionate net asset, asset side 20 belongs to them, we show them at 20. But if NCI is at fair value, asset side 20 belongs to them, we are showing them at 25. So goodwill can come from there also. The goodwill can be only related to our share, or it can be related to our share as well as NCI share if NCI is at fair value. So whenever NCI is at fair value, we call it as a full goodwill method. Whenever NCI is at proportionate net asset, we call it as partial goodwill method, where goodwill will be only related to our share in subsidiary. Okay, moving ahead. Now, while preparing a consolidated balance sheet, so see, on date of acquisition, net asset comes in, NCI comes in, investment goes away, difference came in goodwill capital reserve. वो हो गया that day. Now subsequently, when we are preparing a consolidated balance sheet later on, so while preparing a consolidated balance sheet, the assets and liabilities on the date of consolidation are to be taken. Now we acquired on, say for example, 110, but consolidated balance sheet is on 31st March. We are taking assets and liabilities of 31st March. So assets and liabilities of 110 se leke assets and liabilities of 31st March, there's an increase decrease happening. That increase decrease is nothing but the post acquisition profit or loss of that subsidiary. So for calculating goodwill capital reserve, net assets of subsidiary on DOA is to be taken. The difference between net assets of subsidiary on DOC and DOA represents nothing but the post acquisition profit or loss of that subsidiary. It represents what? Post acquisition profit or loss that is subsidiary. Post acquisition profit related to us will come in our reserves, related to NCI goes in NCI. So parent share in post acquisition profits is added or deducted from parent's profit, while NCI ka share will be added or deducted in NCI. Did you understood? In reality, that post acquisition profit will be coming through SOPL. So SOPL mein, once it becomes subsidiary, their sales, purchase, expense, income is included. In SOPL, consolidated SOPL, sales, purchase, expense, income included from the date they became subsidiary. So can I say post acquisition? And then subsidiary ka profit, matlab consolidated profit usme attributable to owners of parent, attributable to NCI. ठीक है. So pay attention. In short, how do we prepare a consolidated balance sheet? Share capital. The share capital coming in your consolidated financials will only be of parent. Okay, reserves is only of parent plus our share in post acquisition profits of subsidiary comes. NCI will be there if you're holding less than 100%. Assets, liabilities are totaled, our plus theirs. Investment of parent in subsidiary goes away. Goodwill or gain on bargain purchase can come up. Okay, this is how we prepare a consolidated balance sheet. Few questions we do, you'll be able to understand in a simpler way. First few questions are just finding goodwill or gain on bargain purchase. We did a similar question in your Ind AS 103 business combination. Okay, question number 5 is important. Check out. Raja purchased 60% shares of RAM for rupees 525, and number of issued share capital of RAM is basically 1 lakh number. Fair value of identifiable net asset. Asset is 640, liability is 50. So 640 minus 50, net asset becomes 590. And market price per share of RAM Limited. Market price per share of RAM Limited is 775. Find out the goodwill. Now यहाँ पे NCI may be at proportionate net asset or at fair value. Both I am solving. ठीक है, तो consideration by acquirer 525 plus NCI. NCI will be, if it is at proportionate net asset, it will be 590's 40%. And minus identifiable, fair value of identifiable assets and liabilities 775, difference becomes your goodwill or gain on bargain purchase. Achha, if NCI is at fair value, they hold 40,000 share. 40,000 share into 775. 40,000 share into 775, basically you do it, you'll be getting basically the NCI. Fair value of identifiable net asset is 590. Okay. So if I just have the solution here, question number 5. Consideration is 525. NCI, this is at fair value, 40,000 into 775. यहाँ पे 590 का 40%, and fair value of identifiable net asset is 590. Difference is basically your goodwill or capital reserve. Okay, moving ahead, question number 6. December 21 exam, it was asked, you are required to find out non-controlling interest at the date of acquisition as well as at the date of consolidation, DOA as well as DOC. Goodwill or gain on bargain purchase, and what will be the amount of holding company's P&L in CBS, assuming holding company का own retained earning. See, holding company का खुद का retained earning is 2 lakh plus our share in post-acquisition profit of subsidiary to be added. Okay, the first question is NCI on DOA. NCI on DOA is nothing but net asset on DOA into NCI share. Okay, net asset on DOA is capital plus reserves. So this is net asset on DOA into the share of NCI, here 10%. Okay, here iska 15%, here iska 20%, and here it will be 0. Achha, NCI on DOC, how do I find NCI on DOC? NCI on DOA plus their share of post profit, or NCI on DOA plus their share of post profit, or I can have it as whatever is the net assets on DOC, whatever is net assets on DOC into their NCI ka share. So both the ways you are able to do it, that both will be fine. Just a minute. Okay, next question we had was goodwill or gain on bargain purchase. Okay, goodwill or gain on bargain purchase, the consideration is already given to you. Consideration is already given. Add NCI, we already found out NCI on DOA to be taken. And fair value of identifiable net assets on DOA, they're not given you fair value of identifiable net assets on DOA. Take the book value of net asset. How do I find book value of net asset? Capital plus reserve. Capital plus reserve is also the net asset. So that way you can take it, fair value of identifiable net assets on DOA. Third question is holding company ka retained earning is 2 lakh. What will be the retained earning coming in your CBS? So 2 lakh tha plus our share in post profit. Our share in post profit, now see, 50 became 70, 20,000 ka 90%. 30 became 20, minus 10 ka 15%. 20 becoming 20, no change. 40 becoming 55, usme 100%. So this is our share in post profit that you add it, you will be getting your answer. Okay, the steps for preparing a consolidated balance sheet. What are the steps for preparing a consolidation balance sheet? First, we have working notes. 4 working notes mandatory. Working note 1, analysis of reserves and surplus of subsidiary into pre and post. So we'll analyze the reserves and surplus of subsidiary into pre and post. Number 2, will calculate NCI. Number 3 will calculate goodwill or gain on bargain purchase. Number 4 will calculate the consolidated reserves and surplus, and then we'll prepare a consolidated balance sheet. Okay, first question, let me just take it. Analysis of reserves and surplus. ठीक है. So A has acquired B. Normally I take only important question, but this is the first question I'm taking here. Okay, A's investment in B is 70,000 share. So we have 70%. Okay. And when did we acquire? When did we acquire? Let's check the question. 1st July. Okay. Year started. The balance sheet is at December. So year started in January. 6 months pre, 6 months post. 6 months pre, 6 months post. And they've given a P&L and general reserve of 1 lakh each on 1/1. So at beginning, it was 1 lakh each. Okay, if I see over here, we are analyzing reserve surplus of subsidiary. Okay, general reserve opening was 1 lakh, closing is 4, closing 4, so current year is 3. And general reserve current year increase is nothing but current year's profit would have been transferred there. So opening 1 tha, that's pre. Current year ka 3 divided 6 months, 1.5, 1.5. Okay, P&L opening 1 is pre. Increase 5 is current year's profit divided 2.5, 2.5. That way you need to divide it. If I just come over here to the solution, I just come to the solution. Okay, so working note number 1, general reserve opening 1 in pre, current year is divided 6 months, 6 months, P&L opening is pre, current year is divided in 6 months, 6 months. So this is basically the analysis of reserves and surplus. We got total. Out of total belonging to A Limited 70%, belonging to NCI 30%. So pre post हो गया दोनों का. Our share in post further bifurcate. Our share in post further bifurcate. Reason, our share in post is added to our reserves. Pre wala gets adjusted while calculating goodwill capital reserve, but our share in post is added to our reserve. Acha, if we have a post in general reserve, add it in general reserve. If we have a post in P&L, add it in P&L. So our share post to be further bifurcated. Post general reserve was 1.5, our share 70%. Post P&L was basically 2.5, our share 70%. So ye our share post further bifurcated. NCI ka post not to be bifurcated, it goes in NCI only. ठीक है. Now working note 2, calculation of NCI. What is proportionate equity share capital? So what was the proportionate equity share capital? We want their share of net assets. I don't have net asset liability wise. I'll go capital plus reserve wise. So out of 10 lakh, 30% belongs to NCI plus their share of pre-reserve. Pre-reserve is 1.8. So this is NCI on DOA. NCI on DOA is required for calculation of goodwill capital reserve. Then their share of post we add. Now this is NCI on DOC. NCI on DOC is used in balance sheet. The NCI on DOA is used for calculation of goodwill capital reserve. NCI on DOC is used to basically prepare CBS. Now goodwill capital reserve, we already know consideration by acquirer from your balance sheet. NCI on DOA is this, fair value of identifiable net asset. Now how do I find fair value of identifiable net asset on DOA? I don't have net assets and liabilities of DOA. I have assets and liability closing. How do I find on DOA? Acha, so capital full you take. This is full यहाँ पे taken. And pre-total you take, because this is our as well as NCI dono, तो identifiable net asset total is to be taken. So pre-total coming from working note number 1, 6, that you take. So capital plus pre-reserve is nothing but net assets on DOA. So this is how basically we have goodwill or gain on bargain purchase. Working note 4, consolidated reserves and surplus. How do I have consolidated reserve surplus? So general reserve P&L of parent remains same. Our share in post में our share, post our share general reserve, post our share P&L is added. And this is how we prepare. Now coming to balance sheet. Parent ke figures all are remaining same. Capital is only of parent. Reserves of parent are there. Post of subsidiary have been added. Our share in post has been added. Assets total, liabilities total. I hope this is clear. Okay, now moving ahead, I'll be taking only the important question. This was the first one, that's why I took it. Acha, now if NCI is at proportionate net asset, how do I get NCI on DOA? So we have proportionate equity share capital plus share in pre-reserves, that is NCI on DOA. If NCI is at fair value, we don't fair value every year. If NCI is at fair value, we take the fair value on DOA. How do I get fair value of NCI on DOA? Number of shares what they are holding into the price of that company. So that's NCI on DOA. To get NCI on DOC, their share in post profit is added in both the things. So if NCI is at proportionate net asset, then on DOA, the NCI based on proportionate net asset will be proportionate equity share capital plus share in pre-reserve. If NCI is at fair value, so on DOA, NCI will be number of shares into the market rate going that time. It's not fair valued again and again. To get NCI on DOC, we add their share of post profits. Now coming to fair valuation of assets and liabilities, I told you under business combination, assets and liabilities coming in are at acquisition date fair value. So whenever that entity becomes our subsidiary, we'll include their assets and liability which date? Acquisition date के fair value पे. ठीक है, if assets goes up, the net assets on DOA goes up. If asset goes down, net assets on DOA goes down. So how do we give the effect of this? We are finding net asset based on capital plus reserves. तो capital plus reserves ले रहे हैं. तो capital plus reserves when I'm taking, that is nothing but net assets as per book value. So if asset is going up, add it in pre-period. Asset going down, deduct in pre-period. Pre mein why? Because net assets on DOA should go up or down. Liability going up, deduct from pre. Liability going up, add in pre. Liability going down, add in pre. This is to be done. Acha, if asset is changing, imagine it was a depreciable asset. If it's a depreciable asset, so can I say if asset is changed, so uska depreciation also will change. Asset has gone up, there will be additional depreciation coming, which will be only in post. If asset has gone down, there will be a reversal of depreciation coming only in post. Plus one more thing, whenever the value of assets and liabilities are changing, the related deferred tax impact is also to be considered. So remember, whenever asset goes up and down, effect comes in pre, but related additional depreciation or reversal of depreciation, that comes in post. And deferred tax impact will be considered only when question gives the tax rate. If tax rate not given, ignore the deferred tax impact. Okay, moving ahead. It's fine. Now going to the concept of mutual indebtedness, unrealized profit in stock. Okay, what is mutual indebtedness? See, if on the date of consolidation, not acquisition, if on the date of consolidation, parent has to pay to subsidiary or subsidiary has to pay to parent, this is nothing but your mutual indebtedness. It can be in form of debtor creditor, it can be in form of loan taken, loan given, it can be in form of bill receivable, bills payable, it can be in form of debentures issued and investment in debenture. The mutual indebtedness for a group as a whole, can I say I need to pay to myself? So whenever we prepare a CFS, that mutual indebtedness are to be eliminated, remove from asset, remove from liability. Mutual indebtedness will not affect your working notes, it will directly affect your consolidated balance sheet. Then your consolidated balance sheet, we total the asset, then we remove from asset, we remove from liability. Achha, if BR has been discounted with bank, now we are required to pay to bank, so it is not a mutual indebtedness. Okay? Achha, now sir, what happens if mutual indebtedness was there on DOA? If mutual indebtedness was there on DOA, then it would have been considered in settlement of pre-existing relationship. So now whatever I'm paying, usme something is towards that loan and remaining is towards PC. ऐसा हो जाएगा. So that DOA wala automatically gets adjusted whenever we are calculating basically that pre-existing relationship wala thing. So don't worry about that. Whatever is on DOC, date of consolidation, that is to be eliminated as mutual indebtedness. Now coming to unrealized profit in stock. Okay, imagine parent has sold goods to subsidiary, or vice versa. Parent has sold goods to subsidiary or vice versa, and that goods remain in stock with the other entity. So can I say group as a whole, the goods are with us only? Okay, group as a whole, the goods are with us only. The profit recognized on that needs to be removed. So that is unrealized profit in stock. Parent sold goods to subsidiary, parent recorded profit, goods remain with subsidiary. So for CFS purpose, goods are within the group only. Profit recognized by parent is said to be unrealized, remove it. Same way if subsidiary sold it, so profit recognized by subsidiary is said to be unrealized, remove it. So if on date of date of consolidation, if on date of consolidation such unrealized profit is there, we are required to eliminate the unrealized profit. Now sir, how do we eliminate unrealized profit? If parent sold goods, the profit was in parent's book, remove it from working note 4. And opposite stock में से remove होगा in your balance sheet. अच्छा, if subsidiary sold it, remove it from subsidiary's profit, working note 1. We analyze in working note 1. And opposite, remove from stock. Acha, whenever you are removing from subsidiary's profit, it will always be in post, because this unrealized profit in stock is known at the time of consolidation. We cannot go back and change goodwill capital reserve. So this is at the time of consolidation, it is known. That's why it comes only in post period. So parent sold it, remove it from working note number 4. Subsidiary sold it, remove it from working note number 1. Now practically this unrealized profit is eliminated by removing the sales as well as the corresponding COGS. आप उतना sales निकाल दो, corresponding COGS निकाल दो, profit निकल गया. That way how it is done practically. अच्छा sir, unrealized loss, do we need to remove unrealized loss also? Unrealized losses are also to be eliminated unless the cost cannot be recovered. Means if the price has really gone down, so unrealized loss also you eliminate. Parent sold goods to subsidiary at loss, group as a whole, goods are with us. The loss cannot be recognized. But if price have really gone down, they would be actually valued at NRV only. Then no need to remove the unrealized loss. If price has really gone down, don't eliminate unrealized loss. ठीक है. Moving ahead. Okay, see this question 12. Subsidiary sells some inventory to parent. Subsidiary has sold some inventory to parent. We'll remove unrealized profit. How? So practically I told you we remove sales, we remove cost of sales. So automatically a profit निकल गया, सामने inventory removed. Profit opposite inventory. And as it was sold by subsidiary, it will be borne by parent as well as NCI. So it is borne by parent and NCI 60-40. If it was sold by parent, it will be fully removed from parent's profit only. But practically revenue removed, cost of sales removed, indirectly profit removed. An opposite effect comes in inventory. Okay, going ahead. Question number 13. Okay, parent sold goods to subsidiary 200 lakh. 50% of goods are lying in stock. Okay, 200 we sold at 240 lakh, so 40 lakh was a profit made, 50% remains in stock. So can I say 50% profit is unrealized? So 40 lakh ka 50%, 20 is unrealized. 20 is unrealized. We need to remove 20 lakh rupee from profit. Opposite inventory may say remove. But there's a tax rate, 30%. If stock goes down, stock is going down. Asset goes up, we create DTLs. Asset goes down, we create a DTA. So DTA will come up 30%. DTA will be coming up 30%. So also you have to create a DTA of 6. Did you understood? So remove 20 lakh from inventory, remove 20 lakh from profit. Opposite you create a DTA. When you create a DTA, opposite impact profit में आएगा. DTA debit to P&L में it will be coming. ठीक है. Next question number 16. Okay, in your question number 16, A Limited, which is involved in selling capital equipment, a parent entity, a parent sold a capital equipment costing 100 lakh to a subsidiary at 120 lakh. So can I say parent made a profit? Now subsidiary has shown the asset at 120. For parent it was goods, but for subsidiary it's a capital equipment. So they would have provided depreciation on 120. But for group as a whole, the equipment remains with us only. Group as a whole, equipment remains with us only. Depreciation should not be on 120. Depreciation should be on 100 only. So reverse the additional depreciation. So reverse that extra 20%, 20 lakh per depreciation. The two entries are there. Which are the two entries? One, you remove 20 lakh from parent's profit. Opposite, you remove 20 from where? The PP. And now depreciation was provided on 120. It should be only on 100. So 20 ke upar ka depreciation is to be reversed. Okay, तो checkout, ये they would have given a entry, ये revenue and cost of sales 20 rupee profit eliminated. Okay, opposite 20 rupee goes away from equipment. 20 rupee goes away from equipment, but a reversal of depreciation 2. Reversal of depreciation 2, the equipment goes up by 2. Okay, so depreciation 2 rupee goes away, equipment में minus 20 plus 2, net becomes 18. Clear? Okay. Now, question number 17. Question number 17. On 31st March 2, Blue Heavens acquired 100%. Blue Heavens acquired 100% in Orange County for 600 lakh. 31st March. Acquisition date के financial statements are given. Acquisition date only, the financial statements are given. We acquired 100% for 600 lakh, no NCI. Fine. Now, if you check over here in the question, ये Blue Heavens, you acquired Orange County. Assets and liabilities of Orange County will be coming in at acquisition date fair value. वो fair value पे ले लो. अच्छा, we are paying total 6,000. Difference will be coming goodwill or capital reserve. There's no NCI over here. ठीक है. तो consideration by acquirer 600, NCI nil, fair value of identifiable net assets will do it. Difference is goodwill or capital reserve. Consolidated balance sheet figures of Blue Heaven plus assets and liabilities coming from Orange County. Reserves of Orange County will not be coming. To prepare a consolidated balance sheet, this simple. 31st March 2. Okay, moving ahead. So when you acquired, same day's balance sheet is asked. 18th question is same question, but imagine you acquired 75%. If you acquired 75%, can you say NCI will be there? अच्छा, अगर आपने 75% acquire किया, NCI will be there. तो NCI basically comes in, otherwise there's nothing. Same question, only thing is यहाँ पे NCI will be there. And instead of 6,000 you paid only 4,500. Fine. Now, third question over here is important. Same fact as above, you acquired 75% for 4,500. At 31st March 3, after 1 year, 31st March 3, 1 year over. Now the individual financial statement of both are given and you're required to prepare a consolidated balance sheet as at 31st March 3. Now see what happened is, at that time PPE was upward revalued and inventory was upward revalued. Inventory में 100 rupee upward revaluation was done. Now tell me one thing, inventory was upward revalued, तो उसका I had taken in pre-column. But SFS में that inventory would have been sold later. Now, we have already from 500 inventory was made 600. So that 100 rupee profit in CFS was taken in pre. So CFS में 100 rupee profit was already taken in pre. Now, in SFS that profit comes later. So now what happens is that needs to be eliminated, removed. I cannot take again. Now we are basically finding the post profit. From SFS. तो पोस्ट प्रॉफिट कहां से मिल रहा है? एसएफएस में से मिल रहा है. तो द थिंग इज दैट 100 rupee प्रॉफिट inventory 500 becoming 600 and then sold for 600 later. So see, 500 becoming 600, 100 rupee was taken in pre, 600 sold for 600. Now post में related to that profit in CFS should not come, but we are taking from SFS. SFS में that 100 rupee profit came in post, we have to remove it. So check over here. Okay, question number 19. Retained earning DOA was this, today it is 550. Okay, so today it would have been 2850, so 550 is current year basically profit, and it includes profit on sale of inventory which was fair valued at DOA. This is PP, we had upward revalued, and uske related ka additional depreciation comes in post. I already told you. Increase in inventory comes in pre. Now uske related profit is also included in post in this 550. It cannot come two times. यहाँ पे भी लिया, यहाँ पे भी है. तो no. तो post में you remove it. So I have to remove this 100 rupee. Did you understood? This inventory has been sold off later. That's why I have to remove from post. अच्छा, if that inventory was not sold, then that profit was not there in post. वो बेचा ही नहीं था, तो then that profit was not there in post, no need to remove. If it is sold off, I have to remove it over here in post because it's already taken in pre mein tha, 550 mein again came, that's why I remove it. Okay, that was the only thing to be taken care of over here. Acha, one more thing. Now in your balance sheet, the inventory will be parent plus subsidiary ka total. And now this inventory is not there only. This is already sold off. The revalued wala is not there only. So now no adjustment in the inventory appearing in CFS. No adjustment in inventory appearing in CFS. Okay, so just check that note. We already written it in class. Yera, big note. Okay, at the time of acquisition, the inventory was revalued upward by 100. That profit was included in pre. Okay, so in CFS, inventory is 600. SFS, it was still 500. Question specifically says that that inventory has been sold off during this year. So can I say in SFS that 100 rupee profit came up later? So profit of 100 will be there in SFS. And that's why that 550 ka profit which came through SFS includes such a profit. Now in CFS, it was already taken in pre. Again, I cannot take it in post. So I need to remove it. And while preparing balance sheet, we just have to add the inventory given in the balance sheet. We don't have to do plus 100 rupee because that inventory does not appear only. In CBS, there will be no adjustment balance sheet ke andar. Achha, if inventory was not sold, okay, so in pre-column you already taken because it was upward revalued. 550 mein it is not there, no need to remove. 550 mein it is not there, no need to remove. It is not sold. Now, in your CBS, I total the inventory from SFS. In CBS, I'm totaling the inventory from SFS, but one of the inventory has gone up by 100. It's not yet sold, to add 100 in CBS. If it is not sold, add 100 in CBS. I hope this is clear. Okay, moving ahead. Okay, coming to this dividend point. Under your Ind AS, all dividend income go in P&L. There's nothing called as pre-acquisition dividend. Remember, under your accounting standard, the pre-acquisition dividend is deducted from your cost of investment. Post-acquisition dividend goes in P&L. Yahan pe nothing. All dividend go in P&L. And dividends are recognized in P&L only when you have a right to receive dividend. So whenever dividend gets declared at an AGM, you record a receivable. When you receive it, bank to dividend receivable. And there's nothing called pre-acquisition dividend. Okay. Now, what is the effect of dividend while preparing a CBS? So whenever you're preparing CBS, what is the effect? Now pay attention. So while doing analysis of reserve surplus into pre and post, we are analyzing reserve surplus of subsidiary into pre and post, profit before dividend. Subsidiary's profit before dividend. That has to be bifurcated in pre and post, and dividend should be deducted in the period in which the date of declaration of dividend falls. Okay? So you profit before dividend will be apportioned between pre and post on time basis, and dividend is deducted in the period in which the date of declaration of dividend falls. Okay. So this is basically to be taken care whenever you are solving the question working note 1 mein. Okay, we have a question related to it. Let's move ahead. Achha, one more thing. In your CBS, which dividend payable will be appearing? Pay attention. Parent has declared a dividend. Dividend payable of parent, yes, will appear in CBS. Subsidiary declared a dividend. Okay, subsidiary declared a dividend, they have a payable. Can I say somewhat of subsidiary's dividend parent has to receive? The parent would have booked a receivable. The subsidiary would have booked a payable. Parent would have booked a receivable. Wo get knocked off. So subsidiary's dividend payable related to NCI. Acha. So parent ka dividend payable plus subsidiary's dividend payable related to NCI, that appears as dividend payable in your CBS. Moving ahead. Taking the questions which are important. Okay, now this question is good. Question number 24, asked in May 2018, DEF acquired 100%. Okay, you acquired 100%, no NCI. When did you acquire? 1st October. Achha, year ends in March. You acquired in October. 6 months is pre, 6 months is post. Balance sheet is given at March. Okay, March 2 ka balance sheet is given. We are required to prepare a consolidated balance sheet of March. So current year's profit half pre, half post. Okay, so DEF acquired XYZ. DEF ke all figures will remain same. To the figures of DEF, the assets and liabilities of XYZ will be added. Fair value pay. Acquisition date fair value wale. But now when I'm preparing a CBS, I have to add today's lene padenge mujhe. Fine. The retained earning. The retained earning of XYZ shows a credit balance 3 lakh on 1st April. Credit balance 3 lakh was on 1st April. So I understand 1st April ka retained earning 3 lakh. Wo pre mein. And now if you see the retained earning is 820. So 3 lakh becoming 820, 520 going up. Okay, out of which a dividend of 10% was paid. Achha, dividend was already paid on 1st November. So closing is after dividend. Dividend was paid. So closing is after dividend. I told you. Profit before dividend you bifurcate in pre and post. 3 tha. 820 is after dividend. So before dividend to 1020 hoga. 820 is after dividend. 2 lakh is dividend. ये 10% of 20 lakhs. Okay, so 820 becomes 1020. Okay, so 3 lakh becoming 1020. Current year's profit before dividend is 720. Current year's profit before dividend is 720. Divide 720 in 6 months, and dividend deduct in the period in which the date of declaration falls. It's declared on 1st November. 1st November falls in post. Deduct in post. Deduct in post. Done. Okay. Plant and machinery fair value on 1st October is 20 lakh. Okay, 1st October plant and machinery is going up. Uska fair value. That to take it in pre-column. Acha, now how do I find out increase, decrease? So you need to compare the fair value of 1st October and the book value of 1st October. I need to compare fair value and book value. I have a book value. I have a book value of which date? I have a book value of which date? This is 31st March. ये बुक वैल्यू प्लांट एंड मशीनरी ये 31st मार्च का है. 31st मार्च इज 1350 एंड 10% डेप्रिशिएशन इज देयर. तो कहने से बिगिनिंग विल बी 15 लाख. बिगिनिंग 15 लाख था. 6 months डेप्रिशिएशन 75. 1425 रीवैल्यू टू 1425 is revalued to 20 lakhs. So you need to take care over there. ठीक है, let's see the solution. To check over here, ये profit before dividend we have bifurcated, dividend deducted in the period in which date of declaration falls, post में. There's increase in land and building, increase in inventory, increase in trade payable, that's fine. Increase in plant and machinery. 575 कैसे आया? I need book value on DOA. तो book value on DOA कितना है? 15, उसमें से 6 months depreciation you deduct, 75, 1425 becoming this. अच्छा, additional depreciation. Don't take additional depreciation on 525. No. In the books for whole year, depreciation 15 lakh is given. अच्छा, तो we revalued at 20 lakh in second half. अच्छा, तो books में on 15 lakh the depreciation is given for second half. It should be on 20 lakh. तो extra depreciation is not on 575. It's on 5 lakh. So depreciation on revalued amount from October to March. Depreciation books is on 15 lakh for whole year. तो 15 lakh पे था. So additional depreciation this way you need to calculate. Clear? Okay. Then increase in fair values are given. Land and building going up, inventory going up, trade payable going up. ठीक है. Now let's see whether that inventory is later sold or not. Inventory is still unsold. Last question में याद है वो inventory बेच दिया था. तो if inventory बेच दिया था, we had deducted in post that basically 100 rupee. यहाँ पे it's not yet sold, no need to deduct in post. But while preparing CBS, total of inventory plus करो 150. While preparing CBS, वहाँ पे add होगा. That, अच्छा, and trade payable is not yet settled. अच्छा, if that trade payable was settled, so we had fair valued the trade payable went up, and now we settled it, so that loss would have already been recorded in post. उसको ज़्यादा पे किया, तो that loss would have been already recorded in post. I have to remove it from post. So that loss would have been recorded in post. I would have removed it from post. But it's not yet settled. So post mein that loss is not there. No need to remove it. In your CBS, we are getting trade payable from SFS, but usme some trade payable ka value has gone up. Add it in CBS. Okay, so there's one note which I would have written. I'll show you if it is settled, if it is not settled, related that. Okay, in short, are you getting in short? In short, last wala. In short, if asset or liability is fair valued, if it is not sold or settled pre-May, one, if it is fair valued going up or down pre-May, profit hai add, if it went down deduct. Post May nothing to be done. If it is not sold, post May nothing to be done. Pre-May, post May nothing to be done. And in CBS, if it has gone up, add it. If it has gone down, deduct it. So if it is not sold, so it will come in pre and opposite in CBS. Achha, if it is sold off pre-May, we take post May, again it came from SFS, remove it, the opposite of pre, and then no adjustment in CBS. Are you clear with this point? Are you clear with this point? This is actually a revision. We have done it in detail in our class. Thank you. This is a good question. Please make sure you are revising it properly. And I told you, whatever we do in class, better is you do the same thing next day morning. Moving ahead. This question over. Next question is similar. Only thing is it has NCI. Now, uniform accounting policy. Parent and subsidiary. Whenever we are preparing a consolidated financial statement, they should have a uniform accounting policy for like transaction and event in similar circumstances. See the wordings. Like transaction and event in similar circumstances. If at all it's not like transaction or event, then in that case they may follow different policy. Chalega. Acha, parent follows SLM method, subsidiary follows WDU method. They are not accounting policy only. Method of depreciation is just an estimate. Parent following SLM, subsidiary following WDV is fine. No adjustment required. Acha, parent following FIFO method, subsidiary following weighted average method. Parent following FIFO, subsidiary following weighted average. Acha, if it is like transaction or event in similar circumstances, then no. Changes to be done. Subsidiaries figures will be adjusted to bring it in line with policy of parent. But if it is not like transaction or event, then in that case, separate policy is still allowed. Okay. This is done. Here they have clearly written different line of business. Different line of business, the inventory will be kind of different. So one following SLM, one following FIFO, other following the weighted average. Different line hai, to chalega different. Even your Ind AS 2 says for different type of product, you may follow different cost formula. So if there's a nature or use is different, you may follow a different cost formula. That's allowed. Acha, difference in reporting date. Acha, parent year ends in March, subsidiaries abroad, their year ends in December. Okay, so now, normally when we are preparing CFS, the subsidiaries figures also should be of March. So one option is subsidiary prepares one more set of financial statement matching the period ending of parent. They prepare one more set of financial matching the year ending of parent, or another option. If they are not preparing one more set of financial, I can use their December figure. I can use the December figure. The gap should not be more than 3 months. Here December to March, 3 months chalega. I can use the December figure adjusted for significant event and transaction which has happened between these 3 months. The subsidiaries figures of December I can use adjusted for significant event and transaction which has happened during this 3 months, and then the adjusted figures of subsidiary will be used for consolidation. Achha, now subsidiary ka year ends in December. Okay, they have some receivable which will come next to next January. Okay, they have some receivable which will come next to next January. Okay, December hai, not next January, uske baad wala. So can I say they would have shown it as non-current? But when I am preparing a CFS is at March ending. Oh, March ending hai, then the money will be received in January. So CFS purpose, it will be a current asset or a current liability. So for CFS, whether it is current or non-current, try to see the reporting date of a group. Group ka 31st March reporting date, whether it will be realized within 12 months or not, that way you need to check out. Okay, next point we have. This question is already covered under Ind AS 1, bridge, and bridge is rectified after year end. So it's already covered. I'm not going into that right now. Okay, step acquisition we already covered under your business combination. Whenever there's a step acquisition, the earlier investment is to be remeasured. So I'm not doing it again, already covered under Ind AS 103. Okay, NCI. We know NCI can be shown as per two ways. Which are the two ways NCI can be shown? Either at proportion net asset or at fair value. That way it can be shown. Now, pay attention. If a subsidiary has some cumulative preference share which are classified as equity. Achha, if preference shares are classified as a liability, the dividend on it comes under your finance cost. Okay, if they are classified as equity and they are held by NCI people, then even whether the dividend is declared or not, you deduct it mandatory. Cumulative preference share classified as equity. Cumulative preference shares are classified as equity. Uska dividend declared or not, you deduct it, and then the remaining profit. Then the remaining profit will be attributable to parent and basically the NCI. So dividend on cumulative preference share classified as equity held by NCI people has to be deducted, and then your share of profit will be coming. Okay, fine. Okay, change in proportion of held by NCI. Acha, change in proportion. Imagine you had 70%, you are selling 10%. Okay, 70 में से 10 sold. So earlier you had 70, control was there, you sold 10, now you have 60, still control is there. So control was there, control is there. Only thing is earlier NCI was 30%, now NCI became 40%. So 70 में से 10 sold. Acha, imagine 70 में you purchased 10 more. So earlier you had 70, control was there. Now you have 80, control is still there. So now how do it happen? Earlier NCI was 30%, now NCI will become 20. This is change in proportion of NCI. Control was there, control is there with us only. How do I account it for this? How do I account for this? NCI goes up or down? NCI goes up or down? Okay, if we have acquired 10%, I would have paid something. If I sold 10%, I would have received something. The NCI goes up and down, we have received or paid something. Difference goes directly in other equity. Retained earnings, but directly in other equity, retained earning, it doesn't go in P&L. The change in proportion of NCI does not go in your P&L, it goes directly in other equity, retained earnings. Okay, imagine it was 60%, you acquired 20 more, so NCI will go down by 20%. Okay, so check over here. NCI ka carrying amount was 4,000. Can I say 40% was 4,000? Earlier they were 40%. 40% was 4,000, 20% goes away. So 2,000 goes away, NCI 2,000 goes away, I paid how much? NCI 2,000 goes away, I paid how much? 4,000. The extra 2,000 directly debit to other equity. NCI goes away 2,000, I paid, NCI goes away, debit 2,000, I paid 4, difference 2,000 will go directly in other equity. I hope this is clear. Okay, I'm just taking important questions, moving ahead. Okay, now just one thing I want to tell you, pay attention. One thing which I want to tell you, thoda upar. Yeah. Okay, now pay attention. If you acquire 20%, NCI goes down. Decrease in NCI is based on NCI given. 40% NCI was this, we acquired 20, so 20% that NCI will go down. So decrease in NCI is based on NCI given in CFS. How much NCI goes down? Based on NCI given. Acha, but imagine you sold out of 70%, you sold 10, so NCI increasing. Increase in NCI, decrease in NCI is based on NCI given. Increase in NCI is based on proportionate net asset of subsidiary included in CFS today. Increase in NCI is not based on, oh, so 30% NCI was this, now 10% increase will be how much? No, it's not that way. Decrease in NCI is based on NCI given. Increase in NCI will be based on the proportionate net asset of subsidiary which is included in your CFS today. Acha, now just pay attention. If basically NCI is at fair value, so can I say even goodwill relates to them? But if NCI is at proportionate net asset, goodwill doesn't relate to them. So over here, increase in NCI is based on proportionate net asset included in CFS today. If it's a full goodwill method, net asset including goodwill ka that percent goes to them. Net asset including goodwill, if it's a full goodwill method. If it's a partial goodwill method, then net asset excluding goodwill ka percentage goes to them. So under full goodwill method, NCI is at fair value, that is full goodwill method. The NCI appears at their share of net asset plus their share of goodwill. So under full goodwill method, the increase on NCI should be based on net assets including goodwill. But under partial goodwill method, the increase in NCI should be based on net assets excluding goodwill. And if question is silent, we assume it's a full goodwill method. Clear? It's very important to maintain discipline. Attending one day and then you don't attend, that's not going to work. You need to ensure you are there attending all the sessions properly. Then only this will be useful, otherwise it will not be useful. Okay. Moving ahead. Okay, now comes the loss of control. You are selling off your subsidiary. Achha, it can be a complete disposal, it can be a partial disposal. Complete disposal, partial disposal. Imagine you completely dispose of your subsidiary. Achha, completely dispose your subsidiary in standalone book. You are getting money. Carrying amount of investment goes away. Difference is profit loss. SFS. You get money. Carrying amount of investment goes away. Difference is profit loss going in P&L. SFS. Now in CFS. Now see, pay attention. Change in proportion of NCI. The difference was going in other equity, retain earning. Change in proportion of NCI was going in retain earning, other equity. Yahan pe loss of control is there. The difference always will go in P&L. Okay, so subsidiary sold off, simple. Net assets which are included in your CFS today, remove net asset, remove NCI. Goodwill capital reserve which was recorded, remove it. You're getting some money, difference goes in P&L. Difference goes in P&L. So check out, net asset goes away, goodwill capital reserve goes away, NCI goes away, money comes in, difference comes in P&L. Now, if it's a partial disposal, partial disposal mein, after the disposal, still it's a subsidiary. Out of 80, 10% sold. So then it will be accounted like change in proportion of NCI. It still remains a subsidiary, change in proportion of NCI. But after disposal, control is gone. Out of 80%, 40 sold. 80 mein se 40 sold. So now we have only 40, control gone. But can I say now it became associate? Or out of 80 we sold 70, now it's a normal investment. So out of 80, 40 sold, it remains associate. Out of 80, 70 sold, now it will be a normal investment. How to account? Simple. In SFS, SFS में you got money, proportionate carrying amount removed, difference is profit loss going in P&L. In CFS, how to account in CFS? Pay attention. Control gone na, so remove net asset. Net asset goes away. NCI goes away. Goodwill capital reserve already recorded goes away. You got some money, and for remaining, thoda baki rana 40% or 10%, investment comes in. Investment comes in at today's fair value. Investment comes in at today's fair. Whether you retain 40% or whether you retain 10%, investment comes in at today's fair value. If 40% retain, now onwards equity method will be adopted. The investment comes in, difference goes in P&L. I hope this is clear. Okay, moving ahead. Okay, coming to this question number 41. You were holding 100%. Achha, you are holding 100%. Now they issue some convertible preference share. Now they issue convertible preference share, and they will have a right to participate in relevant decision making process. They will have a right to participate in relevant decision making process. So can I say now your control is going away? Okay, now your control is going away. So can I say what do I do? Loss of control. I'm not getting anything. मुझे कुछ मिल नहीं रहा है, तो cash received will be nil. But net asset goes away. NCI goes away. Goodwill capital reserve already recorded goes away. I'm not getting anything, and the difference automatically will go in your P&L to de-recognize the assets and liabilities which were recorded, and that all goes away. And now it's no longer your basically subsidiary, but you have investment. Now the investment will come in at today's fair value. The investment will be accounted at fair value, and after the loss of control, now you'll account it as per equity method because it becomes a associate or a JV. Clear? Okay, question number 42 is not important. Leave it. I'm going to 43rd one. Acha, 43rd, pay attention. AB Limited holds 30% in associate for 300 lakhs, and the fair value of net asset was 900. Goodwill 30 came. Fair value of net asset 900. So 900 ka 30% was 270. We paid 300 to 30. Now see, under your equity method, for your associates JV, we follow equity method in CFS. Pay attention. For associate JV, pay attention. If you're getting bored, kya karenge? Get yourself fresh. Have some water. Do that. This is just to make yourself fresh. Okay. So under your equity method, investment remains as investment. We don't have their assets and liabilities coming. Goodwill we find, but we don't show it as goodwill. So investment in associate 300 including goodwill of 30. That way we write. Investment in associate 300 including goodwill of 30. Okay. So can I say that investment represents our share in net asset 270 plus our share of goodwill 30. Okay. Now the carrying amount became 360. Post profits would have been recognized. Now the carrying amount became 360. So 360 is nothing but our share of net asset plus our share of goodwill. Okay. Now associate issued new equity shares to some other investor. They issued some new shares to others and for 800, and now our holding reduced to 20%. Achha, earlier my holding was 30%. Now my holding reduced to 20%. So say this 360, the carrying amount was for 30%. I was holding 30% of net asset wo tha. But if I am holding 20, so can I say that my investment should be, for 30% investment was 360. So for 20% investment should be 240 only. So from my investment 120 goes away. But that company issued new shares. They got 800 rupee. Okay, so there's an increase in net asset. My share 20%. So 800 mein 20%, my share. So 160. So investment goes down by 120, investment goes up by 160, net your investment goes up by 40, credit P&L. Okay, check solution note which I have given. This whole question looks easy, like basically when you see the notes which we have written. Under equity method, investment in associate represents our share of net asset plus our share of goodwill. So just a minute, I have to go down. Our share of net asset plus our share of goodwill. 43rd question we are doing actually. Okay, so what is happening is we were holding 30%, then company issues new shares to others. So now our holding became 20. Still it's an associate. We hold now 20%. Under equity method, the investment in associate represents our share of net asset was 270 plus our share of goodwill 30, but it was appearing under investment. Fine. So 360 was for 30%. So for 20%, it should be what? So now my investment goes down by 120. But a company issued new shares, उनका net worth increase. उसके net worth में my share is 20%. तो 800 का 20% comes to me. 800 का 20% comes to me. तो 160 comes to me. Net my investment goes up by 40 rupees. Investment in associate going up by 40 to P&L 40. So this will be recognized as gain on reduction of interest in associate. Gain on reduction of interest in associate, 40 rupee gain will be recognized. Is it clear? Okay, next one, question number 44. Next one is question number 44. P Private Limited is number of wholly owned subsidiary including S Private Limited. Achha, we have many subsidiaries including one of the subsidiary S. Okay. Consolidated financial, this includes parent plus all subsidiaries. Now, iske andar S ke values are this. The figures of S included in consolidated is this. Now what happened? We sold off 100% in S for 300 million. Achha, we sold off 100% in S, so net asset goes away. So can I say this all assets and liabilities included in your CFS will go away? This all assets and liabilities included in CFS goes away, NCI goes away, related goodwill capital reserve goes away, and we are getting 3000 rupee difference goes in P&L. So these सारे assets liability, this were already there in CFS. Yes, consolidated में से remove this all figures. This all figures will be removed. We are getting 3000. Difference goes in P&L. So that is how this sum is to be solved. Era check. So 3000 is your sale proceed. NCI was 0. Net asset goes away 2560 already given. This is including goodwill. So don't remove goodwill again. And 440 will go in your P&L. The revised balance sheet, how do I prepare? वो consolidated figures में से figures of that S you remove it. And 3000 came in, वो cash में add करो. 440 you add it in your retained earnings. 440 add it in retained earnings. Achha, imagine if not 100% sold, 90% sold. 90% sold, then investment will come up. Investment will come up at today's fair value. That's the only difference. Otherwise, it will be same. Okay, next. Laptop is working slowly. It's also getting tired. Okay, coming to question number 47, very, very important. Coming to question number 47, it's very, very important. Okay, at beginning, you're holding 90%. You sold 70% for 56 crore. Out of 90, 70% sold. Net asset goes away. NCI goes away. Goodwill capital reserve recorded earlier goes away. We got some money. Acha, 20% we still have. Investment comes in at today's fair value. Difference goes in P&L. Difference goes in P&L. Now, they are telling the fair value of 20% interest is 16 crore. The fair value of the 20% which we have investment will come at 16 crore, and net asset of BC was 60. So net asset 60 goes away. अच्छा, NCI assuming it as proportionate net asset, तो can I say वो 60 का 10% 6 होगा. So net asset goes away 60, NCI goes away 6, goodwill capital reserve not given, ignore it. Okay, we got 56 crore, investment comes in at 16 and balance goes in P&L. Balance goes in P&L. Okay, let me just have the solution. Okay, selling price 56, investment basically 16, NCI is 6, net asset goes away, goodwill not available, remove it, profit or loss is coming 18 rupee. That goes in your P&L. ठीक है, वो हो गया? That is fine. Now there's one more thing which I want to show you in the question. ठीक है. Now that subsidiary के assets and liabilities are gone. Now there were certain assets or liabilities which were fair valued through OCI and related OCI reserves were there. If that subsidiary के assets and liabilities are gone, can I say related OCI balances should also be removed? Okay. ठीक है. Now these net asset included, there was a debt instrument classified as FBT OCI and that was 12 crore. उसका related OCI reserve was 6. उसका related OCI reserve was 6, but pay attention. उसका related OCI reserve 6 था, but our share 90% would be there in CFS. Related to NCI was a part of NCI. So check, 90% of above reserves were included in our reserves and 10% attributable to NCI were a part of NCI only. Okay, I don't have to remove 6 OCI reserve. 6 नहीं remove करना है. In our books, it's only 5.4. That 5.4 FBT OCI reserve needs to be removed. Debt equity, debt instrument classified as FVT OCI, they are reclassified to P&L. So FVT OCI reserve 5.4 goes away, credited to P&L. It's an item reclassified to P&L. अच्छा, net defined benefit liability is there and उसमें net measurement loss is 3 crore. अच्छा, 3 में से 90% would be there in books 2.7. अच्छा, I told you if that related asset liability goes away, related OCI balance should also go away. 2.4 लॉस है, 2.7 लॉस है, आई नीड टू रिमूव इट. लॉस को रिमूव करना है, लॉस एज अ डेबिट बैलेंस, क्रेडिट इट एंड वेयर आई विल डेबिट. डेबिट कहां करूंगा? इट्स आइटम नॉट रिक्लासिफाइड टू P&L, रिटेन्ड अर्निंग्स में डेबिट. तो डेबिट रिटेन्ड अर्निंग्स. ओके, इक्विटी इंस्ट्रूमेंट थ्रू OCI नॉट रिक्लासिफाइड टू P&L. there's a FBT OCI reserve not 4, 3.6 in book. तो 3.6 का reserve I have to transfer it to retained earning. The FBT OCI reserve debit to retained earning 3.6. And a foreign operation, उसके related foreign currency translation reserve not 8, 7.2 in our books. That 7.2 needs to be removed. It's item reclassified to P&L. The FBT OCI reserve debit हो जाएगा ये. This is basically foreign operation का OCI reserve will be debited to P&L. It will be. The total I have to do is 5 entries. First one for this. First one basically for your profit or loss on that sale of subsidiary, that is to be done. वो P&L में 18 will go. Then this OCI reserve on debt instrument we remove. It's item reclassified to P&L. Take it in P&L. Net defined benefit liability का OCI वाला loss, it's item not reclassified. It will go in retained earnings. So that I need to take in retained earnings. Check out. Equity instrument through OCI, that's also not reclassified. That also I need to take it in retained earnings. And foreign currency translation is item reclassified. That will go in your P&L. वो P&L में ले गया. So net effect in P&L is coming this way. Is it understandable? Net effect in P&L, net effect in retained earning. This is what is shown over here. Okay, moving ahead. Okay, come to loss of NCI. Page number is 54. We'll finish off consolidated financial statements today. Other things I think will not be possible. I told you instead of 4 days, now we'll have 5 days. Okay, loss of NCI. See, NCI is made up of two things. NCI on DOA plus their share of post profit. So because of post losses, what happens if NCI is becoming negative? Do we show NCI negative? Under Ind AS, we show NCI negative also. Under AS, we don't show it. So under Ind AS, NCI is shown as negative if it is becoming negative. Okay. In this question, if you check, this was on 1st April, then their share of post profits and losses, loss aaya, we deduct, NCI becoming negative. It's okay, it can be negative over here. It's okay, it can become negative, no problem at all. Okay, next is chain holding. Acha, what is a chain holding? A to B, B to C. A to B, B to C. That is basically a chain holding. Now, whenever there's a chain holding, it's not a direct, some portion is indirect. It may be wholly indirect also, or it may be something direct, something indirect. That's chain holding. Okay, now pay attention. A holds 60% in B, B holds 60% in C. So A holds 60% in B, and see, B will vote in a manner what A says. A controls B. So B will vote in a manner what A says. So indirectly A also controls C. So to decide whether we have a control or not, A has 60% voting power of C. To decide whether we have a control or not, A has 60% voting power in C indirectly. But how much share in net asset a group has in C? B has 60% in C, but in B we have 60%. So can I say group ka share in net asset of C is 36%. So in order to determine whether control is there or not, we consider group has 60% voting power in C. But for accounting purpose, how much share of net asset we are having? How much share of net asset we have in C? So we don't have 60% share of net asset in C. Group ke liye the share of net asset in C is 36%. So while determining control, yes, we have 60% basically thing. So how to account for chain holding? For determining control is there or not, we will consider 60% direct as well as indirect holding. We say we have a 60% voting power in C. But for accounting, what is a group share of it? Group share in net asset and NCI share in net asset in C. So group ka share of net asset will be 36%, 60 ka 60. And 64 will be NCI. NCI kitna hoga? 64%. This you need to take care. Did you understood? ठीक है. This you need to take care. Now, one more thing. Whenever I'm finding goodwill capital reserve, what is happening is, if I'm finding capital reserve for B's investment in B to C ka, so we have two goodwill, A to B, B to C. Now B to C mein, whenever I'm finding goodwill capital reserve, consideration by acquirer plus NCI minus the fair value of identifiable net asset. Consideration by acquirer is for 60%. NCI will take 64, so total 124 ho gaya. The thing is net asset belonging to me is 36%. So cost which I should be bearing should also be for 36%. But the amount which I have paid, B paid for investment in C is for 60%. So cost is for 60%, but my share of net asset is 36%. No. So extra 24% ka cost. The cost was 60, but my share of net asset is 36. So extra 24% ka cost should also be borne by NCI. Reason, they got that extra share in net asset. So while filing goodwill for B to C, I'll remove from cost. वो cost में से 60% के लिए that was the cost. My share in net asset is 36. So what will be the cost for 36%? And that extra cost goes to NCI. वो NCI में भी deduct हो जाएगा. Are you getting it? Group holds directly or indirectly 60% shares in C. So consideration paid is for 60% share. But while doing accounting, we are including only 36% net asset. So therefore, extra cost will be transferred to NCI, and this will affect your working note number 2 and 3. This will affect your working note number 2 and 3. We do a question, it will become more clear to you. We do a question, it will become more clear to you. Okay, this question number 15, November 18, it was asked. We are required to prepare a consolidated balance sheet. There's Usha, Nisha, Sandhya. Usha, Nisha, Sandhya. Okay, 3 balance sheets are given. Usha has investment in Nisha. Usha holds 80% in Nisha. And Nisha has 75% in Sandhya. That's Usha to Nisha, Nisha to Sandhya. So for determining control, group has 75% voting power in Sandhya. Okay, so that is control is there. Now, for determining how much is our share of net asset in Sandhya, the net asset in Sandhya is not 75%, 75 ka 80%. So Nisha has 75% in Sandhya and we have 80% in Nisha. So 75 uska fir 80 kar do. So it is 60%. So group share of net asset in Sandhya is 60%. So our share of net asset is 60, but can I say this cost of investment is for 75? Our share of net asset is 60, but cost is for 75%. The extra 15% ka cost will remove it from our cost, deduct from NCI because they got the extra share in net assets. Okay, so coming to solution. Pay attention. For determining control, we have 75% voting power in Sandhya, but our share in net asset of Sandhya will become 60%, NCI will become 40%. Okay. Now, when we are doing analysis, of reserves and surplus of Nisha as well as Sandhya both. वो Nisha का analysis done. Nisha में parent is 80, NCI is 20. Sandhya. When I go to Sandhya के अंदर there was unrealized profit that is deducted, subsidiary sold, that's why deducted from subsidiary's profit. वो तो ठीक है. Now here, Sandhya में group का share not 75, 60. We have a 60% right in net asset. NCI will be 40%. NCI will be 40%. Did you understood this? Okay. Now, working note to NCI. Now, NCI is at fair value. If it is at fair value, it's fair valued only on DOA. The number of shares held into their share. The number of shares held total 20 lakh mein 20%. And here 16 lakh mein 40% is NCI. As it's at fair value, it comes like this. If it was basically proportionate net asset, then proportionate equity share capital plus share in pre-reserves I'll take. But it's fair value, so based on number of share, uska share price. Then how do I find basically NCI on DOC? Add their share in post profits. Done? Acha, one more thing. Now see, NCI got 40% in net asset. But if you just check out, the cost of investment, Nisha had 75%. We had 75%. Cost हमने 75 bear किया. But the thing is, we have a right in net asset only 60. If right in net asset is 60, we should bear only 60% cost. The extra 15% cost is to be borne by NCI. Okay, if I just go down, I'll come back here. NCI ki note pe. Okay, if you see over here, Usha to Nisha 170 is fine. Nisha to Sandhya 140 was for 75%. We get a net asset 60. We are getting a net asset 60. So we should bear a cost also of 60% only. So our cost should not be 140, it should be 112. Or you can do very simply 140 में वो 80% हो गया था ना 75 का 80%. तो 140 का 80%. That way you do it. So we will be bearing a cost not 140, we will be bearing a cost 112 only. So can I say extra 28 cost? We are bearing not 140, we are bearing 112. So extra 28 cost. Who got that extra net asset? NCI. So extra 28 cost is to be borne by NCI. वो NCI में deduct करो. NCI of किस में? निशा में. तो check out ये proportionate cost borne by NCI ये 28. Did you understood? Only difference in chain holding is this. अच्छा, तो reason is our share in net asset 60%, so my cost of investment cannot be for 75%. I'll bear a cost only for 60%. तो 75% के लिए 140 था, तो for 60% it will become 112. तो I'll bear 112. Extra 28 का cost will be borne by NCI. NCI में निशा में डालना, not in संध्या. This was basically related to chain holding. Other all things under chain holding remain same, no difference at all. Any doubts? Anybody? Any doubts? Anybody with chain holding? Okay, thank you. Keep on replying. I'm telling you, the more you are active, more you're going to enjoy the classes. Now, the last concept of this basically unit is preparation of consolidated P&L. We understood consolidated balance sheet. A consolidated cash flow will learn under Ind AS 7. Consolidated cash flow kahan pe learn karenge? Ind AS 7, leave it. Now going for consolidated P&L. Okay, under your consolidated P&L, how do we prepare a consolidated P&L? Item by item basis. Same. So, sales, purchase, expense, income in the figure of parent, subsidiary are added, but we'll add it from the date the relationship comes, control comes, and we will include it till the time control is there. Imagine we sold subsidiary on 110. If I sold off subsidiary on 110, so sales, purchase, expense, income till 110 will come. Then your consolidated P&L till 110, that all things will be coming. Fine. Mutual incomes and expenses are to be eliminated. There might be some mutual incomes and expenses, they are to be eliminated. A dividend paid by subsidiary received by parent will be eliminated. Okay. If we acquired subsidiary during the year, imagine we acquired on 1st July, so the sales, purchase, expense, income from 1st July are to be included. Unrealized profit in stock needs to be eliminated. See, if you say I eliminate sales, purchase, if you eliminate sale, you eliminate purchase, profit is not eliminated. 100 rupee goods were sold at 120, so purchase 120 removed, sales 120 removed, profit nahi gaya. So purchase 120 gone, sales also 120 gone, usse profit is not gone. So unrealized profit is to be eliminated separately. And generally wo kaise practically it gets eliminated when we are having wo increase decrease in stock. The stock went down, automatically increase in stock also goes down. So that then whatever profit comes in consolidated P&L, that is profit of parent as well as subsidiary. In subsidiary, something belongs to NCI. In subsidiary, something belongs to NCI. You have to bifurcate attributable to owners of parent, attributable to NCI. That needs to be done by you. Okay. When mutual expenses and incomes are eliminated, profit does not get eliminated. If goods are remaining in stock with other party, we need to eliminate the unrealized profit in stock. Okay, check out the question number 53. They've given a P&L of parent and subsidiary. They've given a P&L of parent and subsidiary. These are the things given. I'll just go down. H sold goods to S of rupees 120 lakh at cost plus 20%. Now, of rupees 120 lakh doesn't mean this is a costing 120 lakh. So, this is a selling price only. We sold goods of 120 lakh, sales में से remove, purchase में से remove. ठीक है. Out of that 24 lakh का inventory remains. अच्छा, तो 24 lakh का inventory remains, उसमें unrealized profit will be, it was 20% on cost, on sales it's 20 by 120. 4 rupee unrealized profit in stock is to be eliminated. अच्छा, admin expense of S includes 5 lakh paid as consultancy fee to H. अच्छा, तो H में there is an income, S में there is an expense. So remove from admin expense, opposite you remove from consultancy income. Income में से remove. Selling and distribution expense of H includes 10 lakh paid as commission to S. S का income, H का expense, mutual eliminate. अच्छा, H holds 80% of equity shares prior to 15-16. अच्छा. And now says some dividend. Dividend basically is declared and paid, related to which year doesn't matter. I told you all dividend go in P&L over here. So now dividend whatever is declared by subsidiary ये 150 है. 150 का 80% parent would have received 120. So 120 is mutual. Subsidiary में paid में parent में, received में eliminate that 120 going to the solution. This is consolidated statement of P&L. I directly go to the notes. Okay, sales and other income, they were given combinedly. I took it individually given. Achha, mutual sales, mutual consultancy, mutual commission and mutual dividend income, they all are eliminated. ठीक है. Raw material consumed, उसमें से mutual purchases are gone. Production expense is fine, nothing to be done over there. Admin में से, in your admin, there was some mutual consultancy. In your selling, mutual commission, that all eliminated. Achha, in your inventory, there was some unrealized profit 4 to be eliminated. Achha, there's an increase in inventory. This much. Achha, if stock is reduced, unrealized profit, stock goes down, increase in inventory goes down. So increase in inventory reduces, net increase in inventory 1196. And increase in inventory, stock goes up, profit goes up, expenditure side will show it as negative. Stock goes up, profit goes up, expenditure side I'll show it as negative 1196. So check out P&L. P&L में negative दिखाया होगा. It's an increase in inventory. It's an increase in inventory. I would have shown it as negative here. आजा जल्दी बहन. कहाँ गया? ये रहा 1196. Stock goes up, profit should go up. I'm showing it in expenditure side. That's why I'm reducing expense. So profit goes up. Okay, moving ahead. Employee cost में nothing, finance cost में nothing, this is nothing. Other expense में admin expense, there was mutual consultancy. Selling expense में mutual commission. Current tax nothing. Dividend में there's a mutual dividend, we deduct it. There's a mutual dividend, we deduct it. Income में से removed, expense में से removed. Now, if I just come back to P&L, from incomes, we deducted expenses, we get profit before tax, we deducted current tax, profit after tax, dividend declared and paid, we have deducted. Dividend declared and paid, normally it comes in appropriation, but question doesn't give that data, that's why I take here. Now this profit after dividend. I have to bifurcate attributable to owners of parent, attributable to NCI. Now NCI doesn't get 20% of this. NCI doesn't get 20% of this, NCI gets 20% only of subsidiary. This is parent plus subsidiary both. So don't give 20% of this. So 20% only of subsidiary. Do one thing, come to the question. Only of subsidiary. Achha, subsidiary ka profit. Achha, after tax was 300, after dividend is 150. Now see, dividend we already taken separately. That's why you take after dividend. What is after dividend? 150. 150 ka 80%. We already taken dividend over there. So profit after dividend hai. So they have it 20% only of subsidiary, not total. 150, ये 150 का 20%, 30 will go to them, balance will go to parent, मतलब owners of parent. So check out attributable to NCI will be 30 rupees and attributable to owners of parent is balancing. The profit of subsidiary after dividend into the share of NCI, that is taken because dividend was already taken over here separately. This is basically your unit number 4 of your consolidated financial statement. Still unit number 5, 6, 7 are pending. We go to unit number 5. This was unit number 4, 5, 6, 7. 3 more units to be done. We'll be starting this after the break. So let us take a break of 15 minutes. Again, we are taking a break of 15 minutes and then we'll start with unit number 5, 6, 7. We'll finish off this chapter today. Okay, so I just write down over here. break 15 minutes. We will be back at 9:15 p.m. From 9:15 p.m. till 10:45 will be the last slot. 9:15 to 10:45 will be last slot. 3 more units to be done today. Enjoy your break. Okay, hi, welcome back. Give me high five, thumbs up, everyone. We are doing consolidated financial statements. Unit number 1, 2, 3, 4 is over. Now going to unit number 5, Ind AS 111 joint arrangement. We have to do Ind AS 111. Then we have to do Ind AS 28, investment in associates and JV. And then we are required to do Ind AS 27, separate financial statements. So 3 standards to be done today. Have lots of water. It's going to keep you fresh. Okay, now coming to Ind AS 111, which is on joint arrangement. Now see, joint arrangement is an arrangement where there's a joint control. Joint arrangement, it's an arrangement where there's what? A joint control. So it's an arrangement where 2 or more parties have a joint control. So there has to be a contractual arrangement, not mandatory in writing, and it gives 2 or more party a joint control. ठीक है. Now joint control is nothing but a contractually agreed sharing of control, and decisions one person cannot take. One person cannot take. The decisions are to be taken unanimously by all the parties sharing control. It has to be taken unanimously by all the parties sharing control. So if there is a joint control, then we say it's a joint arrangement. Clear? Okay, then there were a few questions whether it's a joint control or not. That's okay. Now, directly come to types of joint arrangement. When do I say it's a joint arrangement? Wherever there's a joint control. Now, joint arrangement can be of 2 types: joint operation, joint venture. It can be joint operation, joint venture. Now, sir, how do I decide it's a joint operation or joint venture? So, uske liye, if new entity is not formed, it's always JO, joint operation. Now, under joint operation, the parties that have a joint control, they have a right to the asset, obligation for the liability relating to the arrangement. Under JO, the parties have a right to the asset, obligation for the liability related to arrangement. Under JV, the parties have a right to net asset. They don't have a right over individual asset, or they don't have an obligation for individual liability. They have a right over net asset. Okay. So if it is not structured through a separate entity, if separate entity not created, always JO. Separate entity not created, always JO. Achha, if separate entity created, normally JV, but it may still be JO depending on facts and circumstances. So separate entity created, normally JV, but it may still be classified as JO based on facts and circumstances. Now, sir, which are the facts and circumstances? So 1, I need to check the legal form of separate vehicle. Okay, imagine the separate vehicle created is a partnership firm. Okay, if it's a normal partnership firm, so can I say partner has a right over asset, obligation for the liabilities of the firm? Achha, so if a legal form, okay, new entity created, but if it's a normal partnership firm, then it will be treated as JO. So whether the legal form gives parties a right over asset or obligation for the liability of separate entity. Second, the terms of contractual arrangement. The terms. Okay, if we have a terms telling that each party will have a right over the assets and each party will have an obligation for the liabilities of the arrangement, then it will be JO. So one is see the legal form of organization. Second, the contractual terms. And third, other facts and circumstances. Other facts and circumstances. Now suppose the primary aim of arrangement is to provide parties with the output, so that new entity which is created, they will give output only to basically the parties having control. They will not sell it to outsider. They will sell the output only to the parties that have joint control, and the parties are substantially the only source of cash flow contributing for the continuity of the operations of the arrangement. In simple words, if that new entity created is purely dependent on the parties having joint control, they are not working independently, then in that case it will be regarded as JO, not JV. Acha, so separate entity not created, always JO. Separate entity created, normally JV, but it may still be JO depending on facts and circumstances. I have to see three things. One, the legal form. If legal form gives right over asset, obligation for liability, then it becomes JO. Second, I have to see the terms of contractual arrangement. If terms of contractual arrangement gives right over asset, obligation for liability, then it's JO. And third, other facts and circumstances. If the new entity which is created, uska output goes only to the joint, the parties to the joint control, and the parties to the joint control are only source for which, based on which this entity is operating. So can I say this entity is kind of very much dependent? Then in that case, again, it will be JO, not JV. Okay. Moving ahead. Now check over here, question number 19. Check over here, question number 19. There are two parties. There's a joint arrangement. Each party has 50-50 ownership interest. Okay, the purpose of arrangement is to manufacture material required by parties for their own. Acha, so they will manufacture material required by the parties for their own. The legal form of A indicate that assets and liabilities held in A are the assets and liability of A. So as per the legal form, my assets are my assets. Okay, the parties don't have a right over asset. So as per the legal form, if I see, the new entity is created. If I see legal form, it looks like JV, legal form. Okay, arrangement also doesn't tell parties have a right over net assets of the arrangement or obligation for the liabilities of arrangement. No. However, there's some other facts and circumstances. All output produced are basically taken away by the parties in 50-50 ratio. Entity A cannot sell to third party unless approved by the two parties. And the price of output sold to parties is set at a level that it is designed to cover the cost. So can I say over here that entity created is just working for these two joint controllers? Okay, it's not working independently. Okay, so based on that other facts and circumstances, I can say it is not JV, it is JO. So check over here, it's JO. These facts and circumstances indicate it is JO. Fine, moving ahead. Question number 21. Question number 21, RTP May 22 exam, this was asked. A Fresh Vegetable Limited, FVL, was incorporated. The net worth exceeded 250 crore, they are following Ind AS. Fine. Now additional information is given. FVL entered into 60-40 partnership. I assume there is a joint control. 60-40 partnership with Logistic Limited. So Fresh Vegetable Limited entered into a 60-40 partnership with Logistic Limited, and now a new company created, Vegetable Logistic Associate Private Limited. It's not a firm, it's a company. Because if it's a firm don't have to apply Ind AS. The Vegetable Logistic Associate Private Limited, this is basically VLA. VLA, that is a new company created, it's a JV. Okay, it's basically a joint arrangement between FVL and Logistic Limited. If it's a joint arrangement between FVL and Logistic Limited. Okay. And decisions require a unanimous consent. Decision requires a unanimous consent. It's a joint control. There's also an Associate Social Welfare Limited. Determine the applicability of Ind AS. Acha, so now see this associate company, Ind AS applicable. Acha, JV ko, if Ind AS applies to you, it applies to your parent, your subsidiary, your associate, your JV. So if this is a JV, Ind AS applicable. But if it's a JO, Ind AS doesn't apply. JV ko applicable, not JO. Okay, the applicability of Ind AS on VLA, we need to understand whether it's a joint operation or a joint venture. See, new entity has been created. I understand new entity created. If the parties conclude they have a right over assets and obligation for liability of arrangement, then it will be JO. If parties conclude they don't have a right over asset, they just have a right over net asset, then in that case it is not JO, it's JV. Achha, if it is JO, Ind AS will not be applicable. If it's JV, Ind AS would be applicable. And on that associate ko definitely Ind AS applicable. Associate ko Ind AS is applicable. Fine. Question number 22. Come to question number 22. Identify the type of joint arrangement X and Y, they manufacture and sell mobile phones, arrangement is done. They are going to use their own assets. Both are responsible for liability, distributing. However, X has exclusive control over marketing and distribution, and they don't need Y consent. Achha, if we don't need Y consent, can I say it's not a joint arrangement only? X has exclusive control, so it's not a joint arrangement only. Suppose, continuing with above, suppose basically both jointly control all activity. If both jointly control all activity, then in that case it will be a JO because separate entity not created. अच्छा, तो first वाले में it does not fit in the definition of joint arrangement. Second वाले में it will be JO because separate entity not created. Okay, third one. What would be the classification if separate entity created? If separate entity created, normally JV, but still it can be JO depending on whether the parties have a right to the assets of the arrangement and obligation for liabilities of arrangement. So if separate vehicle formed, it can be either JO or JV. If contractual term gives right over assets, then it becomes a JO. If contractual term does not give right over asset, it gives rise over net asset, individual nahi, then it's JV. Okay, fourth, continuing with 3 above, the output is purchased by both X Limited and Y Limited only. Oh, the new entity formed, the output goes only to the parties, and this is just to cover the cost. So can I say the new entity is just basically dependent, then it will be a JO. So fourth one, it will be JO. It's in nature of JO. Achha, fifth, would your answer be different if X and Y sell it to third party? See, the joint entity created cannot sell to third party. XY Limited sells to X and Y sells to third party. But see, the entity created cannot sell to third party, still it will be a JO only. Achha, what would be the thing if the joint arrangement entity is not obliged to sell to X and Y? But the joint entity can sell it to outsider, then it becomes JV. So यहाँ पे it will be still JO, last वाले में it becomes JV. Good question, important one. Good question, important. Keep on replying, बोलते जाओ यार, you just keep on writing JO, JV, क्या है, whatever. Okay, now, so we understood joint arrangement can be of two types, either it's a JO or it's a JV. Sir, what will be the difference? Accounting. If it is JO, how do I account for a joint operation? If it's JO, we have a right over assets of arrangement, obligation for liability of arrangement. So in our SFS, we'll record our share of assets liabilities, and that will continue in CFS also. So in SFS as well as CFS, we will include our share of asset, our share of liability, our share of revenue from sale of our share of output, our share of revenue by selling the output or expenses. So we'll record our share. It's basically in our SFS only, and same will continue in CFS. Achha, now so someone asked me what is the difference between C and D. In C, the output is sold by operator, the other operator sold, I'll have our share. Fourth mein, the output was shared and then I sold my output. So one was output was sold by the other operator, my share of revenue comes to me. Fourth one mein, output was shared, then I sold the output. Both mein, the revenue, our share is basically being recognized. Okay, so now pay attention. Because of JO, we don't need CFS. Reason, CFS is required if you have a parent, subsidiary or associate. You have a subsidiary, associate or JV. JV hai to CFS required. JO में as such CF is not required, but because of some other subsidiary, associate, JV, because of some other, you are preparing CFS, so this figures which were included in SFS, the same continues in CFS. Because of JO, you don't need CFS as such. ठीक है, तो check question over here. Not important, let's move it, chalega. I'm taking only the important question. Our share of assets, liabilities, revenues, expenses, that all will be included in JO in your SFS only. Now, imagine operator sold asset to JO. Operator has sold the asset to JO. If I am selling asset, now see in JO, can I say my share of asset will come back? If my share of asset is going to come back, you record only for the other party. So you record only to the extent of other party's interest. Okay, so check over here. A Limited sold asset of 100. A Limited sold asset of 100 to JO at 120. Now see, if I am selling and now 60% asset is going to come back to me only. So rather than basically recording 100 rupee asset, 60% is going to come back only. So you record entry only for 40 rupee of asset sold at 32. So 40 rupee ka asset sold at 32, that much will be the entry, 40%. Because 60% is going to come back only to me. Okay, if JO sold to operator, JO sold to operator, 60% was anyways there in my book. Now you pass entry only for 40% purchased. JO sold to operator, 60% was already there in my book. Now you pass entry only for 40% purchased. So 40% you purchased. So 100 wala JO selling to A Limited. Now in my book, uska 60% was already there. So now 40 rupee asset JO is selling me. 40 rupee ka asset JO is selling me at 32. Pass entry for you purchased at 32. Asset debit to bank 32. Did you understood? Okay, so when you sold to JO, pass entry only for 40% sold. So because 60% is going to come back. When they sold to you, 60 was already there. Pass entry only for 40% purchased. That is what is to be done. Okay, now accounting for JV. Acha, that was JO. Now how do I account for JV? For a joint venture in your SFS, you will account it as per Ind AS 27. So in SFS, it is accounted as per Ind AS 27, either at cost or as per Ind AS 109. And in your CFS will follow equity method, that will be understood under Ind AS 28. So in your consolidated financial, it is equity method as per Ind AS 28. Under your equity method, what happens under equity method? Under equity method, what happens under equity method? So the thing is, investment remains as investment, but our share in post-acquisition profits and losses we include, and that will be added or deducted from investment. Fine. Okay, question number 27. Question number 27. We jointly started construction of a property. All ongoing expenditure, maintenance, borrowing cost is to be shared equally. Oh, there's a borrowing cost also. 1st April we commenced. It got completed in September. 1st April, say 30th of September. 6 months it lasted. And we started utilizing 1st January. Doesn't matter when you started utilizing. Useful life is 20 years. Total cost 40 crore, divide equally. Acha, it was funded by a loan. We took the loan on 1st April. Annual rate is 10%. And interest payable year end pay March pay. Now see, April mein we took, assuming it's a qualifying asset, April to September construction going on, 6 months ka interest can be capitalized. So 40 crore plus 6 months ka interest. 6 months ka interest is coming basically 50 lakh rupees. 10 crore into 10% into 6 by 12. So 40, 50 is capitalized. 20, 25 you record, 20, 25 I'll record. Okay, 50, 50 hai. Later on, you spend 4 lakh on maintenance. Okay, plus October onwards interest goes in P&L. So October, November, December, January, February, March, 6 months ka interest is again 50 lakh. So that 50 plus 4 maintenance, 54 will be shared equally, 27, 27 each in both the books. Loan 10 crore also, 5 crore, 5 crore in both the books. Did you understood? Did you understood? Okay. Now coming to this question number 28, which was given in RTP November 21 exam. Coming to question number 28, which was given in RTP November 21 exam. Pay attention. There is company X is engaged in business of exploration, development of oil and gas. X hold a participating right in a coal producing block. Okay. So there is a participating right which I am having. X has 30%, Y has 60%, Z has 10%, and total is 100%. Okay. It's a unincorporated joint venture, unincorporated new entity, not created. It's a JO. Everybody will record their share of assets, liabilities, income, expense. Okay. Company Y incurs all expenses and then he seeks a reimbursement from X and Z. And basically all manpower facilities are owned by the joint venture and therefore owned by all the joint operators. Z defaulted in payment. Now see, all payments first are made by Y and then Y collects X and Z ka share from there. Now he defaulted, so now company Y has given a notice to Z. So Z has defaulted. So company Y has given a notice to Z that you go away from our joint operation. You go away from this joint arrangement. ठीक है? तो Z decided to withdraw his participating interest. तो Z का share 10%. तो joint arrangement में से Z is going away. Now that share is being sold to X and Y. तो 10% का 33%. तो this 10% है ना, उसमें 3.33% is sold to X, 6.67% is sold to Y. ठीक है. And as per the agreement based on this date, this is done. X is required to pay 1 lakh. अच्छा, तो out of 10%, उसका 1/3, 3.33, that much portion you sold to X. Now X paid 1 lakh rupee for it, and after signing, government has approved this transaction in June. Government approval was required, so government is approved in June. ठीक है? And the balance sheet of X and Z is given. Now tell me, there was some coal producing block, something over there. It was a joint operation. Can I say everybody would have recorded their share of assets, liability, income, expenditure? So Z की book में it was his share of assets, liability. X की book में it was his share of assets, liability. So Z की book में his share of assets, liability is there. Now Z is selling off. So can I say all that assets, liability, all will go away from Z's book? And who is purchasing? Who is purchasing? Sir, X and Y. 1/3 is purchased by X, 2/3 is purchased by Y. So Z, everything is being sold off. And see, actually, does it meet a definition of business combination? So see, there are inputs. Yeah, वो सारे equipment, manpower, everything is there. There is process. Output भी है, पैसा भी आ रहा है. तो input, process, output, everything is there. So that basically was a business. Z has sold it now to X and Y. The question is, does it fall under business combination? Answer is yes. Acha, if it is business combination, what is the acquisition date when the government approved 30th June? 30th June. ठीक है? तो basically 30th June is the acquisition date. ये agreement date, ये government का approval date, that will be the acquisition date. If it's a business combination, X has basically purchased the business of Z, 1/3 business of Z. X has purchased 1/3 business of Z, Y has purchased 2/3 business of Z. So 1/3 उसके assets, liability, everything will come at acquisition date fair value. Assets and liabilities of Z will come in the books of X, but 1/3. 1/3 at acquisition date fair value, and you are paying 1 lakh. Difference goes in goodwill or capital reserve. Okay, so check out question over here. Fair value of PP development CWIP owned by Z is this. So fair value of PP development CWIP, this and this, iska fair value is given. Instead of 3 lakh, 1 lakh, it is 5 lakh and something. 5 lakh and 2 lakh. Fair value of all other assets, liabilities are assumed to be same except cash and cash equivalent. Cash and cash equivalent is not acquired. So that will not come in my book. Tax rate 30% for DTA, DTL. And every operator records their share of assets and liabilities in their book. So Z was recording its share of assets and liability. Now Z is selling its business. 1/3 of all assets, liability go to X, 2/3 of all assets, liability go to Y. Whether it falls under business combination or asset acquisition, it's a business only. Z ka business taken over by us. 1/3 I am purchasing, 2/3 you are purchasing. Determine acquisition date when government approved. Now journal entry, acquisition entry. Okay, if I go to journal entry, all assets and liabilities are coming in, but 1/3. So PP fair value 5 lakh था, उसका 1/3. Development CWIP fair value 2 lakh था, उसका 1/3. Other all book value का 1/3. Other all book value 1/3. Now DTA, DTL, PP going up, CWIP going up, increase in asset, PP going up, CWIP going, increase in asset, उसमें our share is 1/3. 1/3 उसका 30% I have to create a DTL. DTL. We are paying 1 lakh rupee. Consideration is 1 lakh. Difference is goodwill or gain on bargain purchase. Difference is goodwill or gain on bargain purchase. Now see, they've given me balance sheet of X and Z. I can prepare a new balance sheet of X. X ka balance sheet tha plus 1/3 of Z I bought. Why they are not given? I cannot prepare a new balance sheet of Y. And there's one more question asked, prepare a balance sheet of X. Prepare a balance sheet of X. So balance sheet of X mein this was already there. Ye already tha. Plus whatever things are coming from Z, uske assets, liability, we paid 1 lakh rupee, difference is gain on bargain purchase, that all will get added over here. Are you getting it? Are you getting it? Okay, check out. As it's a JO, every party would have recorded their share of assets, liability, income, expense. Balance sheet of Z given represents uske share of assets and liability. Out of this, 1/3 goes to X, 2/3 goes to Y. Consideration paid by Y for acquiring Z and uska 2/3 interest were not given. Y related data is not given. Balance sheet of also Y is not given. So sum is solved only from X limited's angle, not from Y limited's angle. Then this is your unit number. ये हो गया. 5 going to unit number 6. This was your unit number 5. Let's go to unit number 6 and then unit number 7. Okay. Now unit number 6 is Ind AS 28. Investment in associate and JV. First of all, when do I say it's an associate? See, joint control here, it's a joint arrangement. It can be a JO or a JV, we understood. When do I say it's an associate? I have a significant influence. When do I say I have a significant influence? We have a power to participate in decision making process. Acha. So power to participate is basically the significant influence, and generally it comes when you're holding 20% or more. So if you hold 20% or more, we presume there's a significant influence unless contrary can be proved. And if you're holding less than 20%, we presume you do not have a significant influence unless a contrary can be proved. So sometimes with less than 20% also significant influence may be there. Sometimes with more than 20% also significant influence may not be there. But if you hold 20% or more, we presume significant influence is there unless contrary can be proved. Decision will be made based on. The decision will be made based on your participation in board representation, how much you are participating in policy making process, material transaction, that all thing will be checked out. Material transaction between entity and investee, interchange of managerial person. Do I provide my person over there? My person sits over there. Essential technical information if I am providing. So then in that case, yes, I have some significant influence. Okay, questions are fine. This is whether we have a significant influence or not. That's not relevant. Now, if it's an associate or a JV, not JO, if it's an associate or a JV, how do I account? In SFS, I'll book it as per Ind AS 27. SFS means as per Ind AS 27, either at cost or as per Ind AS 109. But in CFS we follow equity method. The equity method is only for CFS. SFS it will be accounted as per Ind AS 27. Okay, now under equity method, what happens? Investment remains investment only. Okay, the cost of investment 100 rupee, it remains 100 only. But we find goodwill capital reserve. The net assets were 300, our share is 30%. So can I say our share of net assets is 90, but I have paid 100. So goodwill 10, it will not appear under goodwill. Investment 100 including goodwill of 10. So it will appear as investment in associate 100 including goodwill of 10. So can I say that investment represents my share in net asset plus my share of goodwill? In CFS equity method, investment represents your share of net asset plus your share of goodwill. Later on, if that associate or JV earns some profit, in SFS entry comes if they declare dividend. So if they earned profit, SFS the entry comes when they declare dividend, but in CFS, whether they have declared dividend or not, my share of profit I'll include. So profit I'll include. Profit was credited share in profit from associate or JV. Now what do I debit? I have not received money. So investment mein add kar do. Same way if there's a loss, remove it from investment, deduct from investment. So our share in post-acquisition profit or loss of associate and JV is to be included. Opposite effect comes in investment. Did you understand? Now, if they declared dividend, dividend income is already there in your SFS. Dividend income is there in your SFS, and CFS are prepared from SFS. The dividend income already came in CFS also. But we have included our share of profit, and profit before dividend was included. Out of that only dividend given. The profit before dividend was included, dividend they have given is already there in SFS. From SFS it comes in CFS. So CFS now double ho gaya. So now remove it, that dividend income from CFS. How do I remove the dividend income from CFS? So dividend income ko debit karo and credit investment, because earlier I had taken my share. I had taken my share of profit. I've added in investment. If they have paid me something, it's there in cash. वो cash में, the investment made cannot be there. So it's removed from investment. Okay, so first of all, investment remains as investment. We find out goodwill capital reserve, not to be shown as goodwill capital reserve, but only for the purpose of disclosure in bracket. Our share of post-profit loss will include, if they have a profit in P&L, will include in P&L. If they have a profit in OCI, will include in OCI. Same way, if they now basically declare dividend and give me dividend, so that much money I've got, I'll remove that much from my investment, and dividend income I'll remove. Already income was recorded in CFS. SFS mein dividend income came. Now CFS mein it becomes twice. So I'll remove that dividend income. So this is how it will appear. First of all, investment in associate on DOA including goodwill of 10 was 100. Then our share of profit basically 12 came, and then they declared dividend. So our share of dividend I'll now remove it, because in 12 it was already there. वो double हो गया. And now that's received in cash, I cannot show it in investment. Okay, coming to question number 9. Coming to question number 9. See, when we are finding that goodwill, we consider the fair value of basically net assets. So check out, we acquired 25% for 125. Carrying amount of net asset 3 lakh, fair value 4 lakh. The goodwill will be based on our share in fair value of net asset 4 lakh ka 25%. 1 lakh, we paid 125, so goodwill is 25. So check out goodwill 25. Goodwill is 25. So investment in associate represents our share in net asset based on fair value plus our share of goodwill. ठीक है. Now when we are adding our share in post profit, तो see यहाँ पे CFS में our share of net asset is based on fair value. So our share of profit should also consider that additional depreciation related to that change. So now our share in profit, check out over here, the profit is basically 40,000. They earn 40. Our share 40 ka 25%. You say 10. But now the thing is that fair valuation property वो CFS में था, SFS में नहीं. And CFS में, sir, you say sir property where it's fair value. I told you investment represents our share of net asset which is based on fair value. तो वहाँ पे 3 lakh becoming 4 lakh was due to one building का 1 lakh extra. It has a life 20 years. Additional depreciation 5,000 में my share 25%, 1250. So my share of profit was 10, 40 का 25%. My share of additional depreciation is coming 1250. So my share of profit after additional depreciation is 8750. Or you say profit 40, additional depreciation is 5. So 35 का 25% I should be taking. So 8750 is to be included. Plus they have some OCI mein. They have some profit in OCI also. My share 25% in that. Okay, so this was basically the investment 125 including goodwill of 25. Our share in profit after adjustment of additional depreciation. Our share of OCI, and now the closing balance. I hope this is clear. Okay, question number 10 is similar to the 9th question only, no change at all. Only difference is यहाँ पे OCI में there is a loss 15. OCI में profit नहीं है, OCI में there is a loss 15th, our share in loss of OCI. Okay, now coming to exemption from equity method. Exemption from equity method. Sir, is it okay if I don't follow equity method? Okay, the one they have given you intermediate parent exemption. याद है वो ऊपर पहले we have seen. intermediate वाला thing. तो same way यहाँ पे intermediate parent. Second, investment entity related exemption. If you are a kind of investment entity, then in that case, you are exempted from preparing a CFS. You don't have to consolidate subsidiary, associate, JV. You can show them in your CFS, or you can show them at fair value through P&L. Now pay attention. When investment in associate or JV is held by entity that is a venture capital organization, mutual fund, unit trust, or similar like investment related entity, they may elect to measure that at fair value through P&L. Acha, next. When investment in associate, portion of which is held. Now यहाँ पे word portion है. Portion of which is held through a investment entity. So I have direct investment. I have a subsidiary which is an investment entity. I have a subsidiary investment entity through which I have some holding. If a portion is held through an investment entity, then for that portion you can have fair value through P&L. For the other portion held directly, you need to basically have equity method. Let's see the question, you will be more clear. Okay, question number 12, RTP May 2020. Question number 12, RTP May 2020. I'll do one thing, I'll directly go to scenario. Chart wise, it becomes more simple. Okay, there's a parent P. They have two subsidiaries, X and Y. There are two subsidiaries, X and Y. X is venture capital, so investment entity. Y is a normal entity. ठीक है. Now there's an associate Z. Okay, whether it's an associate or not, I need to consider my holding directly or indirectly. So if you see यहाँ पे directly the holding is 0. Directly is 0, but through subsidiary, indirectly is only through subsidiary. Through subsidiary I am having 25 plus 20. So through subsidiary I am having 25 plus 20, 45. So it's an associate. So I am holding 45%. So associate. Now this is through a investment entity. This is not through a investment entity. For the portion which is through a investment entity, you can follow FVT P&L. But for the portion which is not through an investment entity, you have to follow equity method. So check out, the P must follow equity method. For 20%, ये 20% which is not through investment entity, you have to follow equity method. And for this 25%, you may elect to measure at FVT P&L. Okay, second wala, similar, but here it's 30, here it's 10. Okay, so for 30% which is through a venture capital, you may go for FVT P&L, but for 10%, you have to follow this equity method. Yeah, 30 plus 10, total 40, it's an associate. For the portion held through that investment entity, you may go for FVT P&L. For the portion held directly or basically directly hai portion or via normal subsidiary, that you have to go by equity method. Clear? I bet and say this question, if you read on your own, it will be very, very difficult. Now it became very simple. Okay, moving ahead. Now, group's share in associate or JV. Okay, what is your group's share in associate or JV, directly or indirectly? Directly I hold anything, or indirectly through subsidiary. Indirectly is only through subsidiary. You need to consider the share held directly or indirectly, that is through subsidiary. Directly I hold 10%, through a subsidiary I hold another 30, total 40, it becomes associate. Okay. Now imagine you have an associate. Now they have a subsidiary. You have an associate. Now they are having a subsidiary. Now the question is, I need to include my share of profit. So I need to include my share of profit in associate, SFS of associate or CFS of associate. They have a subsidiary. So they also prepare CFS. So my share of profit based on SFS of associate or CFS of associate based on CFS of associate. So when associate or JV have a subsidiary, they have a subsidiary. So then your share of profit in associate or JV will be based on CFS figures of that associate or JV. Clear? Okay, now question number 14. Now see, it's very simple. I have to record my share of profit in associate or JV. If they have a profit in P&L, my share I'll record in P&L. If they have a profit in OCI, my share I'll record in OCI. If they have a profit directly in other equity, my share I'll be recording directly in other equity. Clear? Rohini, are you clear? It's not SFS, it's CFS figures of that associate or JV. Okay, if they have a profit in P&L, my share I'll record in P&L. If they have a profit in OCI, my share I'll record in OCI. If they have a profit directly in other equity, my share I'll record directly in other equity. Fine. A holds 20% in B, वो associate, and B has a subsidiary. B has some 100% wholly owned subsidiary. So associate has a subsidiary. Now out of 100%, they sold 20%. Oh. Associate had a subsidiary. Out of 100%, they sold 20. So can I say earlier they had 100, now they have 80. This is change in proportion of NCI. Earlier NCI 0, now NCI 20. Earlier NCI 0. So out of 100%, 20% sold will be change in proportion of NCI. When there's a change in proportion of NCI, we got some money, NCI comes in, difference goes other equity में. याद है, change in proportion of NCI goes directly to other equity, retain earning, not in P&L. So they have recorded, associate has recorded 100 rupee in other equity. Associate has recorded, they sold some 20% in subsidiary. So they have recorded 100 rupee where? In other equity. My share 20%. My share 20% I'll be recording. If they have recorded in other equity, I'll also record in other equity. I'll record 20 rupee in other equity. That's it. Khatam ho gaya answer. So rupees 20, I need to include it in other equity. Check out. A should recognize 20 as a change in other equity instead of statement of P&L. If associate has profit in P&L, we record in P&L. They have in OCI, we record in OCI. If they have in other equity, I'll record directly in other equity. Okay, moving ahead. Upstream, downstream transaction. Okay. Investor selling to associate, investor selling to associate, downstream. Associate selling to investor. Associate selling to investor is upstream. ठीक है. So now pay attention. Investor is selling to associate. If I am selling to associate, now can I see over there 20% is me only. Over there 20% is me only. So that much profit is said to be unrealized. So I sold some asset. Asset goes away from my book. An asset goes to associate's book. Asset goes away. But the thing is, वहाँ पे 20% मैं ही हूँ. So that much profit is said to be unrealized. I need to remove it. Okay, now if I have sold, asset goes away from my book. I have sold, asset goes away from my book. Now the thing is, what I'll do, I'll remove the profit. I'll remove the profit, and opposite side I will remove it from investment in associate. The profit में से remove करो, investment in associate. अच्छा, if associate sold to me, if associate is sold to me, now associate earned a profit, asset is still with me. So that much profit is unrealized. My share का है, that is unrealized. So I'll remove. Now asset is with me. Asset is with me. I can remove it from asset itself. Asset is with me. If asset is with me, remove from asset. Asset is not with you, remove it from investment in associate. If you sold it, you remove sales and COGS. If you sold it, you remove sales and COGS. If associate sold it, associate ne becha, they had a profit, so that share of profit came. But profit related to goods sold to me, usme my share, that is not to be that is basically unrealized. So that you remove it from share in profit from associate. Okay, the check over here. M has invested in N. Achha, during the year, N sold to M. It's upstream. Associate sold to parent. And second, if it was a downstream, what do we do? Okay, if it's upstream, if it is basically upstream and uske andar inventory of 10 lakh, profit was 1 lakh, 6 lakh is sold to outsider, 4 lakh remains. Acha, the 40,000 ka unrealized profit, 4 lakh remains. Total profit 1 lakh tha. 4 lakh ke upar, on 10 lakh it was 1 lakh, so on 4 lakh it will be 40,000. 40,000 mein our share. The total unrealized profit, total is 40,000. Usme our shares 40% is unrealized. So profit related to inventory is basically total 40,000. But usme our share is 40%. 40% becomes 16,000. 16,000 is basically there. Now associate sold. Associated earned a profit of what? 1 lakh rupee. 1 lakh ka 40%, 40,000 profit comes to me. But in that 40,000 profit, there is some related to that inventory lying with me. So 16,000 is unrealized, I'll remove. Now see, inventory is with me, remove from inventory. Inventory is with me, remove from inventory. And opposite, remove from share in profit. I don't have sales. Sales मैंने नहीं किया था. Inventory with you, remove from inventory. You have not done sales, so remove it from share in profit. अच्छा, if you sold, so you have sales. So remove from sales, remove from COGS. And now I don't have inventory. So remove it from investment in N Limited. If you have inventory, remove from inventory. If you don't have inventory, remove from investment in N. So if you sold it, so remove sales and COGS. If they have sold it, you can't remove sales COGS. They made profit. Share in profit came. Remove from share in profit. Is it clear? Question number 16. Is it clear? Thank you. Okay, moving ahead, long-term interest in associate or JV apart from equity. Okay, so in your associate you hold equity, वो तो है. उसके अलावा you have some long-term interest. उसके अलावा you have equity, तो वो तो है. Other than that, if you have some long-term interest. Now, when do I say it's a long-term interest? Item for which settlement is neither planned nor likely to occur in foreseeable future. I've given a loan, terms are not there, and कब आएगा वापस? Nothing. Settlement is neither planned nor likely to occur in a foreseeable future. So that basically is kind of a other long-term interest. I've given a loan to them, or basically a kind of I've invested via preference shares. So preference share, long-term receivable or loan, that can be other long-term interest. Now, sir, how do I value that other long-term interest? They are valued as per Ind AS 109, not coming here as per Ind AS 109. You have some other long-term interest apart from equity. Fine, this question number 17 is okay, nothing different in that. You had investment including goodwill, it comes this much. Your share of profit, additional depreciation wala point was there, that. And then they have some profit in OCI. So my share of that profit included. And then they paid dividend, I'll remove it. Then they paid dividend, I will be removing it. Okay, now pay attention. If there's a loss-making associate, remember my share of profit or loss in associate I include in CFS. My share of profit or loss in associate I'll include, but opposite effect where do I give? Sir, investment mein. Now imagine my share of loss comes. If my share of loss comes, investment goes down. But now my share of loss is so much that investment became negative. So can I show investment in associate as negative? Can I show investment in associate as negative? Answer is no, unless you have an obligation to pay that. Unless you have obligation to pay negative wala portion, then otherwise you had invested via equity, it becomes zero maximum. So you can't show investment in associate as negative. I'll stop it at zero only. Further, I'll not be booking. Later on some profit comes, so whatever loss I did not book, that much profit also I'll not be booking. Whatever loss I did not book, that much profit also I'll not be booking, and then onwards I'll be booking. But remember, so we say that if our share mein loss comes, investment in associate I cannot show negative. So I'll remove equity wala investment zero ho gaya. Now if I have a other long-term interest, so equity zero ho gaya na. Other long-term interest, if I have investment via preference or loan given, other long-term interest, just now we saw the definition for which settlement is neither planned nor likely to occur in foreseeable future. So then you remove that extra loss from there. And if they also become zero, then stop booking further loss. So first equity mein, then the other long-term interest mein. And now other long-term interest are to be valued as per Ind AS 109. First they are valued as per 109, and then any loss they have to bear, they'll bear the loss. If there is a loss-making associate or JV, entity's share of loss may equal or exceed the interest. In that case, you should discontinue further loss booking. It should be noted that the loss you have to book not only to the carrying amount of investment as per equity method, but also any other long-term interest which you are having. And first, for the other long-term interest, apply Ind AS 109, and then yahan pe loss allocation is going to happen. We have a question over here. Pay attention. Pay attention. We are having 25% equity, plus we have preference, we have a long-term loan also, there are other long-term interest in associate. ठीक है. Now this too will be measured as per Ind AS 109 every year, and this is equity associated 25%. It will be equity method. ठीक है. Now they have given increase decrease in value as per Ind AS 109 in preference shares in your loan, and ये आपका share of loss, entity share of loss in associate. This is given. Fine. Now what were the values initially? So initially 10 lakh, 5 lakh, 3 lakh, this was the value given. Now pay attention. So year number 1, this was 10 lakh, 5 lakh, 3 lakh, total 18. Now first, the other long-term interest are measured as per 109. If you check out as per 109, they are first measured. First year mein preference goes down by 50 and loan also goes down by 50. Okay, the preference went down by 50, loan also went down by 50. Now after 109, these are the value. Our share of loss is 16 lakh. The first towards equity 10. Now other long-term interest they will also bear, and other long-term interest में वो liquidation basis means first preference then comes debenture. तो preference 450, total 16 है, तो 10 gone, 450 gone, remaining 150 borne by the loan people. So now equity became 0, preference became 0, and loan is now 1 lakh only. Now year 2 opening, equity 0, preference 0, loan 1 lakh. Now first this preference and loan you measure as per 109. Now again there is a loss coming of 50,000 in preference. Now preference was 0, I cannot make it negative na. Negative to kar nahi sakta. Again there is a loss basically coming up 50,000. Check out second year mein again there is a loss 50,000 coming in preference. I cannot have preference negative na, 0 hai, minus 50 to kar nahi sakta. So earlier loss which was borne by preference will get reversed. Okay, so now this becomes actually minus 50. Earlier जो उन्होंने loss bear किया था ना 450, तो check out first year में they had borne a loss 450. I cannot show preference negative. So 450 loss which they had borne, 50 is getting reversed, and now they are again 0. So now preference have borne a loss 4 lakh, 450 था, 50 reverse हो गया. ठीक है. And now this year what is happening is वो preference का 50 loss is reversed and 1 lakh is borne by the debt people, and now everything is 0 0 0. So debt people have borne a loss last year 150, this year 1 lakh 250. Preference ने last year 450 था, this year 50 reversed, तो 4 lakh. And now out of over here 2 lakh loss, 50 is recognized, there's a unrecognized loss of 150. So out of this year 2 lakh loss, only 50 loss we booked. Preference में reverse हो गया, यहाँ पे 1 lakh book, net 50. तो 150 is unrecognized loss. 150 तो unrecognized है. Now I come to third year. First these are adjusted as per 109. These are the balances, and now we are having a loss of 150 was unrecognized. 150 unrecognized. I recognize that here 1 lakh, here 50. 150 recognized. So now preference has borne a loss how much? 4 plus 1, 5. And debt people 2.5 plus 50, 3. So ये 5 and ये 3. ठीक है. Now these are measured as per 109. These are the balances. Now there's a profit 10. First give to debenture. Debenture को 3 दे दो. Then give to preference 5. And now the balancing goes to equity people. And next year everything will go to equity people. So this is how you need to do it. This question was done in class extremely आराम से. I hope you are clear. Did you understood this question? Did you understood this question? So equity, I cannot show investment in associate negative. Investment in associate वो equity 0 हो गया. Then other long-term interest के against you adjust the loss. They also become 0. Then stop booking further loss. And our other long-term interest is to be first measured as per Ind AS 109 every year, and then the loss allocation is to be done. Okay, moving ahead. When do I stop equity method? When it becomes a subsidiary, पहले 30 था, you again acquire 30%. Or step acquisition. Earlier interest is to be remeasured. That is 1 when it becomes a subsidiary. Or The retained interest in associate now is a financial asset. Out of 30%, 20% sold. Okay, if out of 30%, 20% sold, what happens? So 10% still hai na? That 10% will appear as investment. That investment will be at today's fair value. So investment in your book goes away. Investment in your book goes away. We got some money and investment comes in 10%, today's fair value, difference goes in P&L. So check, investment ये जो book में था goes away. We got some money for 20%, for 10% investment comes in and difference is going in P&L. Clear? Okay, reduction in ownership interest from 35% gone, 25. So that much investment goes away, we got some money, difference goes in P&L. That much. The proportionate carrying amount of investment goes away, we got some money, difference goes in P&L. Okay, classification of investment in associate or JV as held for sale. Classification of investment in associate as JV or held for sale, what do? Till the time the disposal of portion that is classified as held for sale takes place, till the time you actually dispose, equity method. Follow. Actually जब तक dispose नहीं करते, equity method. Now you disposed, remaining portion. Now you disposed, something you dispose. Okay, remaining portion, still if it's an associate or JV, continue equity method. If remaining portion is not a associate or JV, then follow Ind AS 109. So till it is actually disposed, you follow equity method. Okay, now some portion disposed. So for the remaining is still a associate or JV, follow equity method. Remaining is a normal investment, then you have Ind AS 109. Any doubts? Anybody? Okay, you sold 10% out of your entire 50%. Okay, so till the time you actually sell, continue equity method. Now 10% sold, for remaining 40, you still continue equity method if significant influence or joint control is there. But if significant influence, joint control not there, then it will be valued as per 109. This is your unit number 6, going to the last unit of the day, unit number 7. 5 more minutes. Last unit of the day, 5 more minutes. Okay, Ind AS 27, separate financial statement. So how do I account for subsidiary, associate, JV in my separate financial statements? So they are telling in your separate financial statements, it will be either at cost or in accordance with 109. You know 109 may. In your 109, if it's an equity instrument, you've invested in equity. So normally it is FVT P&L, unless you choose an irrevocable option, then you can go for FVT OCI. Either at cost or as per 109. 109 is FVT P&L. Unless you go for an irrevocable option, then it will be FVT OCI. Now question, investment in subsidiary. Investment in subsidiary, I want to follow cost model. Investment in associate, I want to go for FVT P&L. Chalega? Investment in subsidiary, I want to follow cost, but investment in associate, I want to do FVT P&L. Investment in associate, FVT P&L. ऐसा chalega? Would that be fine? Answer is yes. But 2 subsidiaries are there. One as per cost, one as per FVT OCI. No, that's not allowed. So all subsidiaries you do same way, all associates you do same way, that will be fine. The entity shall apply the same accounting for each category of investment. Dividend is fine. Now reorganization of group structure. If you put in a new entity in between, okay, it was A to B, A say it was B. Now what you are doing? A say double A say B. So can I say new entity double A is put in between? It was A to B. Now you are having A to double A to B. The new entity is coming in between. That's it. So you reorganize the structure by establishing a new entity as its parent. So बीच में नया आ गया. That's it. So this guidance gives you how to calculate the cost of investment. Okay. The new parent got a control. New parent got a control of the original parent by issuing equity instruments to the original parent. The original parent, A had shares of B. So A gave away the shares of B to double A and double A gave its shares to A. So A was having shares of B. So now double A got the shares of B from A and I gave my shares to A. So now पहले क्या था, A was having shares of B, now A has shares of AA shares of B. That way it happened. ठीक है. Assets and liabilities of the new group, original group are kind of same, and the owners are actually kind of same. So absolutely still the owner, still who will control everything? A Limited. Now in this case, if all above conditions are fulfilled, 3 conditions were there, all conditions are fulfilled, new parent AA elects to account investment in the original parent at cost. If new parent elects to account for its investment in the original parent at cost, then new parent shall measure the carrying amount of shares of equity shown in separate financial statement of parent at the date of reorganization. What is this? Pay attention. There were owners, there was company A, owners to company A, and then company A had 2 subsidiary B and C. Now new entity created, owners to new entity, and from there it's company A. So ये new entity created in between, new entity is created in between. The owners have transferred the shares of A to the new entity gave its shares to owner. So as per the things, owners will transfer the shareholding of A to new company will give shares to the owner. ठीक है, fine. Everything as such remains same, ultimate ownership is remaining with the same owner. The cost of investment in A, in the books of owner, so owner had invested 10 lakh rupee in A, ठीक है, and total equity of A as per SFS is 15 lakh. अच्छा, तो owner ने invest किया था 10, total equity of A is 15 lakh. Now new company wants to record investment in A at cost. The cost will be what? 10 lakh? Nahin. Cost will be what? 10 lakh? Answer is no. The cost will be, check out, if the new parent elects to measure at cost, then it will be what? It is nothing but the carrying amount of equity item in SFS of that original parent. So what is the carrying amount of equity? 15 lakh. So it will be recorded at 15 lakh. So how do you record this? The new company will measure cost of investment in A at 15 lakh because all 3 criteria are being fulfilled. Any doubts? Anybody in today's work? We finished business combination chapter and we finished consolidated financial statement. That's only what we did today. Business combination and consolidated financial statements. Any doubts? Anybody in today's work? 3 more sessions. We did 2. 3 more sessions to be done. Total 5 sessions required. Initially I thought 4, but 4 mein nahi ho raha hai. We will be taking total number of 5 sessions. And just one sentence for you. He who struggles is better than he who never attempts. See, the problem is basically if you're not trying only, that's a trouble. Many students, I know your exams are very, very nearer, but many students, they skip few chapters. I tell you, never ever skip any entire chapter. At least do the important things, whatever are marked as important by faculty in that chapter. If you're skipping few things, I found that chapter difficult, मैंने छोड़ ही दिया. You didn't try, you didn't struggle for it. If you are struggling, it's okay, but if you're just leaving it, you're not trying only, that's not going to work. Same way in examination. Exams देने में your preparation might not be apt, but still you struggle, you go and give examination. But if you don't go only, imagine I skip my examination. If I'm skipping my exam, I'm 100% fail. If I'm skipping, I'm 100% fail. If I go struggle, I write down something, there's 1%, 2%, 5% chance I may clear it out. Never ever skip. Struggling is okay, quitting is not okay. Chalo, see you all tomorrow, same timing. We'll meet again tomorrow 5 p.m. and tomorrow we'll have session number 3. Topics which I'll be doing, I'll put it on our Telegram channel so that you're able to understand from there. Bye-bye. Good night, everyone.